Loading charts, having fun, feeling good. How's everybody doing today? Howdy. Everybody happy as a clam? Are we clam happy today? I hope. I'm rooting for it. All right, guys. Big news at 8:30. Man, that made the market go nuts, didn't it? Um, happy compared to being unhappy, Ron. 8:30 a.m. guys, we had some really big high impact news, core PCE price index, and I mean the market went crazy. Don't hear me? Can you guys hear me? Anybody? Josh has it? Yep. Nice, Gino. All right, so Ron reboot. We'll see if we can get Ron in and out of here. Loud and clear. Awesome. Good stuff. Josh, you took a ride at 8:30 but got lucky. Man, I don't think I have ever gotten lucky in news in my life. Don't think I ever got lucky. No, it was 8:30. Gino killing me. That's awesome. And congrats. Gold met third day in a row before the open. Very nice. Very nice. Yeah, man, we've all been run over by news at least once, and that's why we check it every day, guys. That's why I come to forexfactory.com, and I look for those high impact. I look for those red boxes. So we're gonna have it again, guys, at 10 a.m. At 10 a.m., somebody's gonna say something that makes somebody with deep pockets absolutely freak out and change their course of direction. So understanding when news prints, it's the first advantage that you give yourself. Um, Next stop, as usual, we're going to go over to the education page. And I'm going to remind you guys that everything that I talk about is coming from this page. I had a great conversation, little chat with somebody. And they told me, they're like, Mark, what you teach really isn't enough to create a thriving business. Um, but it's a good start. And for a second, I was like, man, what do you mean it's not enough for a thriving business? But I understood where he was coming from. Um, Rob, no sound, I guess. All right, Zora, I wasn't talking. You have no sound either? Guys, I can reboot. Here. We'll give it a try, though. Josh, you and I are on a private wavelength. Hold on just one second, guys. Yeah, I know, right? I'll go through, and man, I'll kill everything that I'm doing, and we'll try it again. So I don't know if you guys can hear me. If you can, I'm talking from the great beyond. But let's get this back up and see if it worked. My Discord is coming up right now. Starting. Here we go. What do you guys think? Can you hear me? I'm rooting for you here. I still can't see you guys, so I'm getting there. Okay, you guys got me? Good. All right, that's about as good as I can do, guys, is keep rebooting and just hope for the best. So if for some reason you can't hear me, well, then you can't hear this anyway, so it doesn't matter. We never liked you. None of us in the room liked you, so. All right, cool. Guys, everything, everything that you need to be successful is from this page. And one of the things, hey, Elvis, do me a favor. I know you like to show off a little bit. Write your rules on your chart. Otherwise, one chart, no rules, all sorts of winning. It just doesn't do any good in this classroom. So do me a favor. Write some rules on there, and I'd love for you to share them in the room. I want to go back to the conversation I was having. It was a great conversation about, man, I don't think that this gives you enough for a thriving business. And And at first I was like, well, that's because everything that I teach in this room, guys, is basic. It's fundamentals. It's learning to read your charts. It's teaching you how to use the tools so that you can use them most effectively in your world. And then I thought about it and I thought, well, one of the things that I give every day is a KISS plan, is a high probability, optimize your chances of success, wins more than it loses plan. Um, and man, you can build a trading plan off of a very basic plan. You can build a plan that can create a thriving business off of a very basic plan. I guess first you have to define thriving business, but if what you learn in this room gives you the opportunity to make $500 a day, that's $126,000 a year, basic, without any compounding or anything like that. And then it stands to reason that if you get to the point to where you can make $500 a day every day, eventually you're going to take that knowledge and you're going to turn it into 1,000, right? And then you're sitting around $250,000 every year, and that's a pretty thriving business. And then if you do like what the more experienced traders are doing, and you take that $250,000 and you spread it out over 20 accounts, guys, that's a lot of math for me, but it seems like it's millions of dollars a year for sitting in your room and reading some indicators and just following rules. So um, I'm going to respectfully disagree. The very most basic foundation will give you a thriving plan if you choose to allow it. But the key is sticking with it, is being able to do the same thing every time you do something, to be able to follow the same rules every time you do something, to be able to manage the trades the same every time you do something. Hey, good morning, Kev. And then what that does for you guys is it creates consistency. It allows you to take trades that create a statistical advantage. And that's what this classroom is dedicated to. This classroom is dedicated to teaching you to read your indicators so that you can learn to make good decisions for yourself. And all of the answers, everything that you need to make those good decisions comes from the tutorial section. Um, it's kind of like um, you're going to have aha moments. Good morning, Muser. You're going to be in a position where you're like, shoot, this is hard. And then you're going to be like, oh my gosh, that just got a little bit easy. And then you're going to start seeing things. You're like, oh my gosh, I never even knew these opportunities existed. And then you're going to be like, holy smokes, I'm consistent. And guys, that's the natural progression. And I make um, a lot of comparisons between golf and trading. So if you guys are golfers, you may identify with this. Um, Guys, I got caught in a rut for a while in my golf game. I got stuck um, where I couldn't aim, and I kept trying to make par, but I couldn't aim, and I kept trying to shoot under 80 or under 90, but I couldn't aim, and I never bothered to address the idea that I couldn't aim. I just wanted to do better more and more, and then when I addressed the issue, and I got a little coaching, and I learned how to fix it. Well, then I started making progress, and but that wasn't it. That was only one piece of it. And then I wasn't hitting my irons flush and all these different things. But every time, and Maddie, I could use it. Yesterday I went out and I played and I fixed one thing. I focused on one thing that I was doing poorly and I kept hitting the ball fat, which means that I would hit the ball, I would hit the ground behind the ball and then hit the ball, and it screws everything up. And I watched one video, and I had one person in one video. What they said resonated with me, and it made sense, and it clicked, and I had this moment. And I went out and I played golf yesterday, and I still made mistakes, guys, because I'm not a good golfer. I had five penalties where I went in the water. I hit five different sand traps, which I usually don't. And I managed to score a 90 yesterday, despite the penalties, despite I parred six holes, and I'm excited about it. And I was hitting irons better than I've ever hit irons in my life. And it was exciting, but it was that one little tweak that it was to get me where I needed to be. It was that one little tweak that put me on the path. And guys, that's kind of what this room is. is you've got to come in and you've got to try and you've got to do things and you've got to learn things and you've got to mess things up and you've got to hit bunkers and hit it into the water. But then you've got to come back and you got to figure out how to not do it. And then once you figure these things out for yourself, once you learn how to follow some rules and a simple process, the results kind of follow. So there was my analogy. And it was a little bit of a brag because, man, I was stoked yesterday. Um, and this is for you guys that know golfing. You will get a kick out of this. Is two of my five penalties were on the very last hole. I was on pace for like an 86 and I triple bogeyed, or an 87 and I triple bogeyed the last hole. So you're gonna have bad days, right? You're gonna have bad holes. You're gonna have bad moments, but we're gonna learn how to fix them all. And we're gonna do it with chart reading, guys. You are gonna become chart readers. I'm rambling all over the place this morning. Sorry. Um, and everything, and that's it, Gino, shot by shot, right? But we don't do that. We think about, God, that's the one that I like. We think about the $1,000 or the $1,000 that we want to make today, but we don't talk about what it takes to get there. We don't talk about the processes that it takes to get there in our heads. We just chase the goals. And you just met your goal, Cap. So you and Gino are both on sim going into the weekend feeling good. What a great feeling. Um, a lot of rambling. Sorry, guys. Let's talk about what we're going to do today. We're going to talk about chart reading. First and foremost, we're going to focus on a high probability trend trade. We're going to do the high probability trend trade because that's a trade that typically wins 70 to 80% of the time. That's a trade that creates a lot of confidence. That's a trade that really just, it teaches you how to use the tools that you've just invested in. This is the trade that teaches you to read your charts. I like that, Ron. Um, and I can't overstate the importance of just learning to read your charts, learning to be able to look at your indicators and understand what they're telling you. Because once you can do that, you're going to see a million options. You're going to see all these opportunities. Chart reading is literally about 90% of what you do every day. There's a lot of patience in trading. My brother used to say, we're professional waiters. We're not traders. We are professional waiters. We are making more money the more we wait for the perfect scenario. And your chart reading is going to let you do that. It's going to help you recognize advantages. You're going to understand where the market is likely to continue. This is going to become your entry point. You're going to understand where the market is likely to go. This is where you're going to take profits. And you're going to understand where the market is likely to stop. And this is where you're going to have to say to yourself, now I really have to be patient. This area may stop the market. Your chart reading is going to take you into the realm of understanding advantages. When there's advantages present in the market, and then those advantages are going to take you into trade entry precision. And then trade entry precision is going to require management. So it's this set. Three divergences, Paul. When there are three divergences in the same price range, it's a termination condition on the small chart. Can I address that when we get into small chart three divergences? And I'll go a little deeper into it for you. Absolutely. I know it seems pretty subjective, right? Three divergences. I'm gonna show you exactly what I mean. No, you're okay. And I'll write it down. I've got it. I've got a piece of paper in front of me. So I've got three divergences, same range, and a big word that says explain. So we're going to go in depth on it for you. Cool. And Paul, thank you for that. Because guys, when you need a little help with a concept, all you have to do is ask, and we'll turn it into a lesson. Same thing I say every day, guys. If you really want to be good at this, show me what you're doing. If you really want to be able to read your indicators, show me how you're reading your indicators. Some of you do it wonderfully. Some of you have small mistakes that need a little tweaking. And that's what this classroom is designed for, guys. When you post in the room, it's a private session with me. So if you post a trade in the room, what you're saying is saying, Mark, I want you to look at my read. Mark, I want you to tell me if I'm reading my indicators right. And the only way I can do that is if you tell me what you're doing, right? You have to tell me what your read is, or tell me what your rules are, especially if it's a kind of outlandish trade. Tell me why you did what you did. Tell me where you did what you did. And I say it every now and then, and I'll say it again today, guys. This room is not your grandmother's refrigerator, right? We're not going to pin everything up just because you did it. We're not going to put that handprint turkey, good morning, Roku, up in the room just because you're proud of the way the feathers came out. This is an educational room, so tell me what you're seeing. Open yourself up to feedback. Take that constructive criticism. And my goal and my hope every day is to be able to take what you're showing me, and then we can get a little bit better. Your reads can become a little more clear. Your concepts can become a little more established. And that's really the path to getting you to where you want to be. That, and use the spreadsheet that Nexgen gave you. Guys, your spreadsheet is nothing more than a trade journal. That's all it is. It is an ability for you to put everything on paper that you do in the market. It's a way for you to track your progress. It's a way for you to recognize patterns. It's a way for you to build trading plans. And the more time you spend with pictures and your spreadsheet, the quicker you're going to get to where you want to be. Your spreadsheet has a trade journal on the first one, the first tab. The second tab is where I've broken down each rule for the high probability trend trade so that you can go through and see them visually, so that you can commit each look to memory so you know what you're looking for. The third tab is where you're going to build a trading plan. When your chart reading puts you in a position where you're like, holy crap, I see this pattern all the time and I absolutely love it and I want it to be a part of my plan, you're going to build that plan. You're going to be able to go back and make sure that it does win more than it loses. And then this is the client trades. This is where you guys have done great things. And I've been stealing pictures from y'all for over a year now. There are entry sequences for longs, for shorts using that high probability trend trade. There's management. There's patterns that repeat themselves. There's termination conditions. There's a wealth of knowledge in this spreadsheet. All you really have to do is click on it, look at it, fill it out, and it's going to pay dividends for you. We're going to spend the first hour. We're going to learn how to recognize when it's okay to trade. You're going to learn the Fibonacci rules and the trigger line rules for when it's okay to trade. We're going to do this for the high probability trend trade. We're going to do this for a trade that typically wins 70 to 80% of the time, one that creates confidence through the memory of success. But the whole reason that we begin with a high probability trend trade, the whole reason that we focus on learning to speak in terms of advantages, the whole reason that I don't cover every trade possible is because the high probability trend trade turns you into a chart reader. And once you're a chart reader, great things come together, guys. You'll find so many opportunities in the market. But your chart reading is designed to let you know when your rules are met. Your chart reading is designed to let you know when you have a statistical advantage. So we don't trade chart reads. There's a lot of patterns that create a lot of expectations. We trade rules that our chart reads confirm. So guys, you're going to simulate and you're going to post pictures and you're going to make sure that you have the correct rules. And the correct rules are rules that have been proven to win more than they lose. The correct rules are going to be rules that provide a statistical advantage. I'm going to give you a plan called the KISS plan today. The KISS plan is going to keep you focused while you're new. It's going to keep you focused while you're learning to read your indicators, and it's going to turn you into a chart reader. And then your chart reading is going to open up those doors that all of you want to have open. So you've got to learn the simple looks so that they're easy. So when we talk about the rules, we're going to talk about strong trigger lines. That's our first rule. If you don't go through and take 25 pictures of strong triggers so that you always know exactly what it is, well, then you're cutting yourself a little short there, right? And if you don't embrace each rule and you don't focus on each rule and you don't learn the looks from each rule, how can you be expected when the market is moving, when your adrenaline is going, to know exactly what it is that you're in for? So you're going to learn these looks, these rules, and you're going to do it by taking pictures, by annotating charts, and then if you need help with it, sharing it in the room so that I can help you. There's only 3 rules to the high probability trend trade. It's difficult sometimes to not try to create more, right? The large triggers must be, or the trigger lines must be strong on the large chart. That's the first rule. It's only one look. There's only one look that creates strong triggers. There's not a million variations. But when you have it, it gives you the advantage of momentum. So each rule provides an advantage. Termination conditions must be false on the large chart. And once again, Termination conditions, there's one way to have a termination condition. I'm going to give you the look, I'm going to give you the recipe, because when they're false, you're going to have room to your targets. But when you have a termination, one of those likely to stop areas present, you're not going to have a clear path. So their absence creates a clear path. And momentum and a clear path on the large chart is going to have you looking for an entry. And you're going to be able to pinpoint exactly where the market is most likely to continue. You're going to do this with a very simple rule, and it's going to happen on a smaller, faster chart. So for the brand new user, days 1 through 30 probably, your trade is the high probability trend trade. Your trade is a trade that typically wins 70 to 80% of the time. So what does that mean? If a trade typically wins 70 to 80% of the time, is it fair to suggest that just due to mathematics, that trade has to lose 20 to 30% of the time? This is where you also have to accept that you will take losers in the market. But my goal is that you take the correct losers. You take the losers that you went into with a statistical advantage. You take the losers that gave you momentum and a clear path in an entry area. And another thing that the high probability trend trade does is it teaches you how to lose. It teaches you how to accept losses, and it teaches you to speak in terms of advantages. And you're going to get to this point where you say, man, I had momentum and I had a clear path and I had an entry area, and the market still decided to kick the ever-loving crap out of me. And guess what? That's okay, because I can't win all of them. I'm just going to take the best of the best and know that over the course of 100 trades, I'm going to win 70 to 80 of them. Your 3 rules happen on only 2 charts. It's a large chart, small chart. Big crowd, small crowd. Big crowd moves the market. Big crowd creates direction, momentum. It reacts to the areas. It's a very broad stroke of a brush. And this broad stroke of a brush, need my laser penner, happens with just 1 bar on the large chart, guys. There's a wealth of information in 1 bar on the large chart. You're going to understand which direction the market is moving. If the background on your large chart is green, the market is, for all intents and purposes, going up, and you should only be looking as a new user for high probability trend trades long. If the background on the large chart is red, you're looking for rules to be met for high probability trend trade short. And just going with the direction of the market creates a very definite advantage. You're going to understand the momentum in the market on the most current bar, and that's rule number 1. And you're going to know whether or not the people in charge have reached one of these key areas that can be problematic. That's rule number 2. And when those are met, you're just going to look right, and you're going to look at this small chart, and you're going to take what happens in 1 bar on the large chart and refine it down and pinpoint exactly where the market is likely to continue. You're going to give yourself the best of the best entry that reduces your risk, that increases your profit potential. And then that's rule number 3. Rule number 3 is a small chart entry rule. The other 2 rules are met on the large chart. So simplicity says keep it on 2 charts, keep it on 3 rules. And rule number 1 says that we must have strong triggers. So when the market is moving up, when the background is green, your small triggers, the solid lines, a fast moving average, and your large triggers, the dashed lines, a slow moving average. These 2 work together to create strong triggers. Strong triggers means that the large or the small break above the large, that there is space created between the 2. This space lets me know that the odds are favorable for the market to continue up. We call that odds favorable momentum. You're going to hear it in class all day long. When you have odds favorable momentum to the upside, that's the best of the best time to buy Fibonacci support on that smaller, faster chart. The advantage of momentum pushes the market in the direction of the trend. The advantage of momentum has the ability sometimes to break key Fibonacci areas. And the advantage of momentum very often will cover mistakes or create opportunities for the new user. In a downtrend, the small triggers are down, the large triggers are down. There's space between the 2, like scissors that are open, ready to cut. And when I have this look, the odds are favorable for the market to continue down. So I will be looking to sell Fibonacci resistance on a smaller, faster chart to go with that flow. Odds favorable momentum is an awesome advantage. Odds favorable momentum gives you so many great things in your favor. And then it doesn't last forever. And I think this is the part that bums you guys out sometimes is odds favorable momentum isn't a forever process. Odds favorable momentum starts at the separation when the triggers agree, and odds favorable momentum ends when the small triggers return in. And guys, this space right here, this is the best of the best. This is the brand new user, best of the best. This is the highest chance of success for the new user. So I encourage you guys to focus on odds favorable momentum as a brand new user. Don't ever forego that advantage. And what you'll find is as you grow with the software, you'll get really good at catching shorts with odds favorable momentum. You'll be able to pinpoint where the market is most likely to continue. And then as you grow, as you progress, as you become a chart reader, you're going to recognize that when the small triggers return to the large triggers, but everything says down and all your charts agree, well, now you're going to find more advantages outside of that highest probability trend trade. And you're going to have the ability to read your charts and maybe manage them aggressively if need be. And the same is true even when the small triggers work their way inside of the large triggers. Guys, this is a weakening. This is a look that tells you anything could happen up or down. There will be a point in your life where you can still take short trades, but you go into these short trades understanding that your best of the best advantage is gone, and you're going to have to use your chart reading to manage these trades very, very aggressively. Quick profits, base hits. And then when you hit Fibonacci support, resistance, one-to-ones, when you smack into an area on your large chart and these triggers are weak, these are when the areas tend to hold. These are when they tend to create bigger bounces and even reversals. And that's kind of the segue to rule number 2. But before we go to rule number 2, let me ask you guys, is everybody cool with the idea that when the smalls separate from the large, this is the best of the best look? And guys, I want you to see what the market did. It just kept flying up. And then the triggers began to return and the momentum is decreasing. And I get those anything can happen triggers. And remember, we just said it, when weak triggers hit areas, they tend to reverse. And holy crap, there it goes. Odds favorable carries you all the way up to the area. They begin to weaken, and that precedes the reversal. Odds favorable pushes down. There's one of those tails. Odds favorable pushes up. So guys, if you're in your first 30 days with me, if you're serious about wanting to become good at this stuff, let's do this. Let's take a picture. And this is how we're going to fill out our spreadsheet. I'm going to take an arrow and I'm going to point at strong triggers. And guys, this annotation is going to reinforce this rule. It's going to cement it in your brain. This is strong triggers. And don't just put strong triggers. Why? Because the smalls are above the large, and that space means strength. This is odds favorable momentum. This is rule number 1. So guys, what I did here is I've got the visual, right? Here's my visual. This is what I'm looking for as a brand new user. Here's what it's called, strong triggers. Here's why they're strong triggers. Here's my advantage and my connection to the rule. And if you go through and you take these pictures and then you come back to your spreadsheet and for 25 times you drop this picture into your spreadsheet, different of course, but you take the time to annotate, what happens is it becomes very difficult to ever miss strong triggers. It becomes very difficult to say to yourself, man, this strong trigger look right here didn't break the area, because for 25 times you made sure that there was separation. For 25 times you went through and you reminded yourself what the rules are and what those advantages mean to you. And then what happens is you stop getting suckered in to these weak trigger looks. You stop taking these loss of momentum looks because you 100% believe in the idea of momentum and the fact that because through repetition, look at how far the market pushes. Look at it go. Yeehaw and wee. So you start to develop this trust in strong triggers, and sure enough, the market continues to push down. So give me a Y in the room, ladies and gentlemen. Are we on board with strong triggers? Is everybody good with the idea that this is your best of the best, that this is the one as a brand new user? Just stick to it. You're gonna grow. You're gonna find more opportunities, but until you're good at chart reading, let's give ourselves the best of the best. Once we have it, let's make sure that we don't hit one of those areas. Guys, remember I showed in the picture, showed on the live chart, today's market, gold. Where did it go? That when we hit some of these key areas, where did it go? There it is. We hit areas and look at the bounce that's happening. We hit areas and look at the reversal. Right off the areas, down it goes, and right off the areas, up it goes. Guys, these areas have the potential to stop the market. These areas have the potential to create problems. And when the rules are met, these areas are what we call termination conditions, guys. These are where the people in charge are making decisions. These are where the people that move the market are entering or exiting. This is where sometimes you'll just see them fight for a while, and you never have to be caught in that fight. So your large chart is going to help you define these. Your large chart is going to use lines to identify problems. That's the easiest way to say it. Large chart defines areas. Rule number 2 is going to allow you to know whether or not you have a clear path or whether or not you need to pump the brakes. So the areas in question: divergence highs and divergence lows. Magenta lines and cyan, means light blue lines. Red Fibonacci resistance, yellow 1-to-1s, and blue Fibonacci support. Guys, these are where decisions are made. You are not the people making those decisions. These are the people that can move the market, the people with the money, the people with the power behind them. They are deciding whether or not they want to exit or enter. They're deciding whether or not they want to maintain the momentum or decrease it. They're making all these decisions. You guys are just going to take advantage of their patterns, and these lines can cause trouble. So we're going to use the trigger lines, the T3 trigger lines, the same trigger lines that establish momentum. We're going to use those, and you guys are going to have this unbelievably clear understanding about whether or not these lines are likely to stop the market, whether they have the potential to break, or whether that they've already been broken, whether that path is clear and you should be looking for your rules to be met. And everything begins with price reaching the areas, guys. This is where trades happen, or decisions are made. Excuse me. This is where, if the sellers are in control, they're pushing the market down, they're screaming to the downside when they reach this big blue line. Well, that may be as far as they wanted to go, and they may jump ship, which creates an untradeable bounce. This may also be where twice as many buyers are just waiting for them to get there because that's their entry price. And once again, it creates an untradeable bounce. So allow price to reach the area. If price is up here and it hasn't made it yet, the blue line is a target, guys. And if you find your rules met, that's where you're hoping to get to. But if price reaches an area and the triggers remain above, that area is a termination condition. That area may stop the market. It may create an untradeable bounce. That area is where buyers and sellers may fight. And this is an area that you don't want to go short into, because this area is taking away your clear path. So a clear path happens when both your small triggers and your large triggers get to the other side of the area. So up here, price reaches support. And when it does, none of the triggers are through, not in the moment. So you guys all say to yourself, hey, I'm going to sit on my hands and do nothing. I'm going to wait for the path to clear. Well, your small triggers and your large triggers get to the other side. Notice that it was momentum that broke the area. And now your path is clear right on that most current bar. And on that most current bar, not only is the path clear because the triggers broke, but you also have momentum, which is your cue to sell Fibonacci resistance on a smaller, faster chart, to use a line on a smaller, faster chart for entry, and you're going to ride that momentum all the way down to your target, right to that next key area. And when price hits it, you're going to say to yourself, let me exit my position. Let me see what the decision is here, rather than hope that it breaks, rather than pray that it holds, right? So guys, it's pretty simple in the beginning. If price reaches an area and the triggers remain below resistance, if they remain above support, it's okay to do nothing. It's okay to sit on your hands and wait for the reaction. If both the small and the large get through the area of resistance, well, then resistance is broken. It's going to behave as support. And that's where you're going to look for your rules to be met. That's where you're going to look for that odds favorable momentum. And you'll be able to pinpoint where that tail is most likely to form on a large chart by using a smaller, faster chart to buy Fibonacci support. So quick question for new users, and I just want to make sure that we're good because that's what I do. Price reached Fibonacci support. Not one trigger line broke through. They were also weak. And the market reversed right off of it. Guys, can you give me a Y in the room if you see it? This is live. This happened 2 minutes ago. Textbook, right? Price reached Fibonacci resistance. The triggers weren't able to break it, and the triggers were weak. And that's what set off the market going down. Again, right at resistance, the triggers don't break. That's your termination condition. And that's what stops it cold. Look how when it hits support, the market bounces. Look how when it hits resistance. So guys, once again, your job so that you can become the best chart reader ever is to take the picture. Let's circle it, right? And then let's draw an arrow to it so we know exactly what we're looking for. And let's use that call out button. And let's write the recipe, right? That is actually gold, Paul. Price reaches the area, and it's resistance in this case. Triggers do not break the area. The cool thing is, Paul, is the patterns work everywhere. The rules are the same, whether it's gold or crude or the S&P. A termination will always be a termination if price reaches the area and the triggers remain below. This is a termination condition. This is not a clear path. Rule number 2, not met. So now we've got our second picture this morning, guys. Now we have a termination condition. So I'm going to share that link again, and I'm going to go back to my spreadsheet, and I'm going to find my termination condition, and I'm going to do this. I'm going to drop it in, and I'm going to post my link. I'm turning it into a hyperlink. And I'm just going to say no more longs, right? Because my rules say no more longs if there's a termination condition. But I also need to know when the path is clear. So let's do this. Let's back up a little bit. And let's take another picture. Guys, everybody's good with the termination, right? So now let's do this. Let's say small and large, right? I'm going to use 2 arrows here. And I'm going to say both small and large triggers cleared resistance. It's broken. I have a clear path until I hit the next area. Rule 2 met. So now in one picture, look at this. I have defined a termination condition, and this tells me no more long trades. But I've also defined when the area is broken, when it behaves as support, and I can start looking for trades, guys. And the easiest trades that you'll ever take are trading from areas to areas rather than trading into areas. So guys, here's your clear path. Let's grab the link. Let's go to our spreadsheet and let's drop it in here. So once again, what we're doing is we're creating recognition through repetition. We'll call this one clear path. Not very clever. We're creating repetition or recognition through repetition. I'm going to take this picture 25 times so there's no question ever what it looks like when an area has broken. And there's no question ever what it looks like when an area has the potential to hold. Man, look at that. Isn't that amazing that you guys knew about this line long before you ever hit it? That you knew about that resistance before the market ever got there? And guys, this is one of the advantages that you get, and this is one of the advantages that your rules give you. Allowing it to be very black and white as a brand new user. This is a termination. This is a clear path. This is your highest chance of success as a new user. But you're going to become brilliant chart readers, guys. And you're going to say to yourself, Well, strong triggers can break areas. If they didn't, the market would just like rattle in between two lines for eternity. So I'm going to introduce you to the next scenario. And the next scenario is not a high probability scenario. This is going to be your first medium probability trade. And a medium probability trade is defined when most of your indicators line up for a trade. However, small issue exists. In this case, your small issue is that 6980 hasn't broken. The small and the large are not above it. But I want you to look at the trigger lines. The small trigger lines have smashed through that area, but the large trigger lines are lagging behind. 50% of your triggers are through the area, 50% are not. Guys, we call this a 50-50 trade. And what it means is that with all this momentum, 6980 has the potential to break. But because the large and small aren't above yet, it's not actually a clear path. And rule number 2 isn't met. So you're going to have to rely on your chart reading to make sure that you don't sacrifice momentum or the perfect entry area. I'm going to give you a plan for taking it. But first 30 days, learn to be a chart reader. Go through, take those pictures. And you can actually go through too, and let me show you why it's not high probability. I'm going to open up crude oil again, or excuse me, gold again. Here the small triggers broke through, but the large triggers did not, and you would have lost that short, right? And here, where did we go? The small triggers broke through, but the large triggers did not. The small triggers broke through, but the large triggers did not. Once again. So guys, this 50-50 look it can be a good look, and there's a lot of money to be made on it, but the conditions have to be right. Now I'm going to give you the recipe for when the conditions are right, because very often there may be an opportunity on a 50-50, and there may be an opportunity on that 50-50 trade, but it typically happens when the market reverses from one of these key areas. So we're using termination conditions not only to say no more, but you're going to use it as an anchor for the highest probability trend trade possible. So moving on. Price comes down, price goes up. We call that a pivot. Price goes up, price comes down. We call that a pivot. That's all it is. Up and down. Doesn't mean that there is a reversal. Doesn't mean it's destined to go the other way forever. It's just a pivot. When there is a loss of momentum at the pivot, you're going to see a cyan line print from a low. You're going to see a magenta line print from a high. We call this divergence. Divergence means that momentum is not following price. That's all it means. Price made it all the way down to here. The momentum is lagging behind. You're going to see the cyan line print right about the third bar. This loss of momentum is nothing more than a loss of momentum. This loss of momentum means that there was a loss of momentum. It doesn't mean anything else. It's not a catastrophic failure. It's not a reason to go long. It's not the end of the world. The sky is not falling. Guys, do not give divergence more power than it deserves. There is a loss of momentum in the market. This line prints, price creates it. But if price returns to that divergence line and the triggers remain above, everybody remembers the recipe, right? Now, it's what we call a pivot stop out. And a pivot stop out is a very definitive termination conditions. And if price trades below that divergence line and then back above, no more short trades. And guys, this is such a steadfast rule. This is such an important rule that it's in the user guide. It's right there. If price trades above a divergence line and back below, no more long trades from a high, no more short trades from a low. Probably one of the most broken termination condition rules. And we're doing that because right where the buyers stole the momentum from the sellers, it's like they're taunting them. They're like, all right, sellers, I dare you to come back. And they will. And then the buyers sell them out or take over right there at that pivot stop out. These are very powerful. They're more powerful when they coincide with Fibonacci resistance and support. Definite termination condition. And then my favorite picture, guys. Price reaches these yellow one-to-ones. And there probably wasn't an opportunity to make money on the way down. And a lot of you are going to be tempted to go short right into these one-to-ones, hoping that the market gives you money. It creates a big untradeable bounce off of it. Rule number 2 was not true. The market reverses. And sure enough, it bounces all the way up to here. Notice that all the trigger lines remain below resistance. I've got termination conditions both directions. I can't go long or short. I have to sit on my hands. The market pushes back down. I don't have odds favorable momentum. I don't even have rule number 1 met. And guys, this carries on for about 45 minutes until finally small and large get above resistance, and now it's behaving as support. Smalls are outside of the large. I have momentum, and sure enough, there's that tail. This is where you guys are pinpointing like a surgeon, where the market is most likely to continue. It is not uncommon to see new users blow out accounts in these transition periods. It is not uncommon to see people trying to form opinions about what the market's going to do rather than just waiting for the rules to be met. So it's these transition areas in between fibs. It's these transition areas when the momentum isn't there where accounts are lost, guys. It's these indecision places where you can get caught in buyers and sellers fighting it out. But if you're just a little patient, you'll find that the right trade typically shows up. You just got to not give it away during these areas. So is everybody comfortable? Price reaches an area. If the triggers remain above support, below resistance, do nothing. Just wait a minute. Go pet your dog or something. If the small triggers get above the area, but the large triggers haven't yet, there still might be an opportunity with all that momentum, but that's a medium probability opportunity. And your best of the best, ladies and gentlemen, is with that clear path. That's the easiest path to success for you. And this is termination conditions. Remember, the large chart is defining these areas, right? The large chart is telling you whether you've reached an area or you haven't. The large chart is telling you whether you've cleared an area or you haven't. Well, there's one more termination condition that I'm going to talk about. And Paul Flowers, here comes your lesson. 3 divergences in the same price range may stop the market. 3 divergences, 3 losses of momentum may stop the market. Guys, you're going to see this on a small chart before you ever see it on a large chart. So if you see 3 divergences in the same price range from a low or a high, that smaller, faster chart is going to help you kind of see when the large chart, that slow-moving chart, can't give you the information to let you know that it's going to reverse. So what is the same price range? There's going to be times where it's common sense. Boom, 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 all within a point or two of each other, right? There's going to be times where it's absolute common sense. There's also going to be times where you're going to kind of guess, is that the same price range? Is that not the same price range? So let's talk about that one real quick because, and you know what, Paul? Yeah, like if you're at 52 here and you're at 51 here, that's the same price range. But the easiest way, and then Paul, I'm going to ask you just to make sure, are you comfortable with the rules for when an area is broken, right? So if I have 3 divergences in the same price range, this says don't do it, right? That says, hey, don't go short yet. Things are changing. It may push up. I don't know. And then let me show you this right here. I'm going to draw a line off of that final divergence. So Paul, the easiest way to do this is when your small and large triggers get below that divergence line, then these are out of the mix. That 3 divergences is no longer a challenge for you. And on that same token, if you have this divergence here, when the small and the large get above that divergence, it's in the rearview mirror. We're not worried about it anymore. Same is true, 2 divergences. Once we get below it, these are the rearview mirror, and this becomes your first divergence. Does that make sense? So I'm using that same idea on broken areas with divergences. So let's see if we can find one more, right? 3 in the same range. I would say that's probably a pretty good assessment. And then here, the small and the large are unable to break it, and this actually becomes kind of the 4th, right? Or maybe the 1, 2, 3 because they've broken that one. And so you're gonna become more and more familiar, and you won't have to do those little calculations in your head. Is it actually above it? Is it below it? And you'll get a feel for it. But until you get that intuitive feel, use the same recipe for broken areas on the large chart with these divergences. Three divergences in the same price range has the potential to reverse the market. And I think that we just saw it on gold, that just because there's three divergences, it doesn't mean it's the end of the trend forever, right? It doesn't mean that the market's going to push up forever. It can still go down, but you see how it pushed it up enough that it might have ruined your good time? Um, so don't say three divergences will absolutely reverse the market indefinitely. It's just a great little pump the brakes. Don't go short. Rule number 2 isn't met. It becomes more powerful when you have those anything can happen triggers. It becomes more powerful if that third pivot's higher than the low or lower than the high from a high, creates a head and shoulders pattern. So when you're looking on your small chart, if you're like, man, I can't wait for that short trade, and three divergences print, it's okay to say, damn it, rule number 2 is not met. I'm not going to go short. And then sigh your relief when you don't lose that trade. And the same is true for highs. So, guys, those are termination conditions. 99.9% are on the large chart. Price reaches an area, triggers don't break, sit on your hands. Large chart is defining the momentum, right? Large chart says it's going up with strength, and I haven't reached the area. Can you guys give me a Y in the room if you're with me? Because this is going to be the look on your large chart. This is exactly what it's going to look like when it's time to go long, when it's time to look for that long trade, when we begin to look for that entry. And the entries happen on the small chart. So the way that lines create problems on the large chart, we're going to use lines on the small chart to pinpoint our entries. We're going to use these key areas on the small chart to pinpoint where the market is most likely to continue. And you guys are going to do that with such precision that rule number 3 says, I'm going to use a limit order. I'm going to wait for the market to come to me. And I'm going to use a limit order at an area, fibs, midbands, yellow, 1-to-1s. But I'm going to insist that that area is inside of favorable large triggers. And I'm going to talk about favorable large triggers before we do anything. And remember, entries are the small chart. Favorable large triggers means that your large triggers, which are the smooth triggers, that moving average that you use with the small to determine momentum, and your synthetic triggers, which are these stepped looking triggers. And these are just the large triggers from the large chart. When these are trending one on top of the other, guys, there's this beautiful symbiotic relationship between the small and large. That moving average is tight, it's concise, it's clear. These trigger lines represent where I expect this price to return to. They are not an entry point. Trigger lines are not an entry point. But when you tuck an area inside of that trigger point, now I have something for the market to bounce off of. So rule number 3 says that I'm going to use a limit order to buy or sell a pullback, and a pullback is nothing more than this little push in price that's created by the people that are not the large crowd. And that pullback needs to happen at an area, fibs, midbands, yellow, 1-to-1s, and I want those areas tucked inside of what we call favorable large triggers. Why do I do that? Because if the trigger lines are the correction point, when they begin to splay and when they begin to separate and they begin to split, I've doubled the correction points. I don't know if it's going to be the large triggers or the synthetic triggers. I don't know if it's going to bounce up here or if it's going to bounce down here. Hell, I really don't even know if it's going to bounce at all, but I know that my plan says that my statistical advantage comes when I tuck an area inside a large and synthetic that are one on top of the other. This is what reduces my risk. This is what increases my profit potential. This one will have to increase risk dramatically, and it creates a lot of indecision. So as a brand new user, focus on the idea that favorable large triggers creates a great advantage for you. Focus on the idea that the tighter they are, the less risk you're going to have, and that feels good when you're taking a trade. And we're going to use the small chart to refine the large chart. What happens in one bar on the large chart is going to be 15 to 30 bars on the small chart. The bottom of the most current bar is hopefully the beginning of our pullback. The top of the bar, where those tails form, is hopefully an area of resistance inside of favorable large triggers. If everything works out the way it's supposed to, These two charts work together. Broad stroke, refinement, and your entry is right here. You are sniping those entries. So let's go through one together. Large chart has to lead the way. I love that phrase. Large chart, excuse me, must have momentum. The large chart should have a clear path. If you're a brand new user learning to be a chart reader, guys, you should be solid on this look. You should be great that the triggers are below. And this says, man, let's look for a trade. Step one is wait for the reversal bar. Wait for that fight in the market. Let some yahoos go against direction and the trend and the clear path. Because when they do, it's going to set you guys up to take an entry. Your entry is not the reversal bar. The reversal bar starts the beginning of the fight. The first thing I want you to do is find your trigger lines. The tighter they are on each other, the smaller that box is going to be. The wider they are apart, the more space between the two, the bigger this box is going to be. Guys, this is like a 20 tick box. That's a $200 box. That's a lot. So we're going to refine it. We're going to find the areas inside of that box. We're going to look for fibs, mid-bands, yellow, one-to-ones. Trades come from areas. Trades originated areas. Trades come from a bounce point inside of favorable large triggers. So you're going to create what we call the window of opportunity. And this is going to extend from the smallest or the lowest point of resistance, fibs, mid-bands, yellow, one-to-ones, doesn't matter which one it is, to the highest point of resistance, fibs, mid-bands, yellow, one-to-ones, doesn't matter which one it is. I don't rank them in terms of power. I just want to see them inside of favorable large triggers. This box represents where the market is most likely to continue. This is the area where we anticipate the bounce, so the market continues with momentum, so it continues with the clear path. This is where the bravery comes in, ladies and gentlemen. You're going to activate a limit order. You're literally going to wait for the market to come to you. You'll typically have 2 to 4 minutes from the reversal bar to the entry in a normally moving market. That 2 to 4 minutes is going to feel like 2.5 seconds to the brand new user, which is why, hey, dead horse, let me kick you around a little bit. You've got to be super comfortable with these looks. You've got to be very comfortable with what you're looking for so that you can get this limit order in place. And the great thing is that if the market decides to come back and hit it, you're in a short trade. And you're not just in a short trade because you hope it goes down. And you're not in a short trade because you're wishing that you could make a little money. You are literally in the short trade because you have the advantage of momentum, the advantage of a clear path, and the advantage of that entry area where the market is most likely to continue. And guys, your goal for your first 30 days with Nexgen is to be able to pinpoint that window of opportunity and begin trusting it. Because this is the trade that typically wins 70 to 80% of the time. This is the trade that creates an enormous amount of confidence through the memory of success. This is the trade that turns you into a chart reader. And once you're a chart reader, guys, the sky is the limit. So you're going to use 2 charts. When the large chart has momentum and a clear path, the first 2 rules, you're going to look for an area of support inside of favorable large triggers. This is your best of the best spot for a bounce. And this becomes how you can study this look as well, and I'm going to show you. If I go back historically, right, just scrolling back on a Tuesday night, and I circle the tail on the large chart. We don't trade tails. We don't trade wicks. We don't trade anything on entries on the large chart. That circle should show up on your smaller, faster chart at an area inside of favorable large triggers. And if it does, this is your trade, guys. This is your best of the best. This is the highest probability trend trade that you can take. You should go back to your favorite looks and you should say, man, this is the one that I'm going to build a plan off of. This is the one that taught me to be a chart reader. We're going to have some fun. Shazam! That's the best of the best. That's the look that I never want to miss. So you're going to study that look until it becomes second nature. You're going to practice those entries until you can refine it down to that very small point. Whether the market is going up or down, you're going to have the capacity to make money with the highest advantage possible once you understand this trade. And then the cool thing is that when you know where the market is likely to continue, this is my favorite part about it, you know where the market shouldn't go. The market shouldn't blow through that window of opportunity. If it does, you're going to have a protective stop there. And here's the thing, guys. If you have momentum, if you have a clear path, if you have the best clearly defined entry area and you lose that trade, you're going to learn to be okay with it. You're going to say to yourself, man, that's just a cost of doing business. I had every advantage, and I know that if I take this trade 10 times, I'm probably going to lose 2 or 3 of them, but I'm probably going to win 7 or 8 of them. And you become okay with acceptable losses. Whether it's long or short, man, getting outside of that correction point, having your protective stop there is cool. You're managing your risk. And then once all that momentum and a clear path gives you a reversal bar, which is more often than it doesn't, you're going to reduce your risk even further, about 2 ticks above or below that reversal bar. And this is really where the advantage of pinpointing that window comes into play. Losses are a normal part of a positive equity curve. Because of the precision that this entry provides, guys, you're going to find yourself taking 2 to 3 tick losses at times. And this is one of the greatest things that you can do as a trader. Because if you're only losing $50, but you're making 300-400 on each trade, guys, that's a pretty hard way not to make money. So everything that you do initially should revolve around great entries. Everything that you do initially should revolve around finding the best of the best spot for entry. Everything that you're looking for as a brand new user is that odds favorable momentum. And I'm going to go to, whoops, wrong one. Let's shuffle through a couple markets here and see if we can go through an entry sequence. I like this one. This one just happened. There's a termination that reversed the market. From that termination, I had odds favorable momentum. With that odds favorable momentum, it pulled right back to resistance, right inside of the triggers, and guys, it is still going down. Anybody take that one? Pretty cool, right? There's the pattern that we just talked about. What did this tail look like? Pull back to support right inside of favorable large triggers. Pull back to support. Oh my gosh. How about this one with the potential to break? Looks like crude oil's putting on a show today. You don't want to sound like a hole, but you did. You did take it? How on earth could that make you an asshole, Jen? Well, and if you are an asshole, you're an asshole with the most money because you followed the rules, because you embraced the advantages, because you took the trade. And guys, all we're talking about right now is putting yourself in a position to win more than you lose, putting yourself in a position. And what do you think? Let's draw a circle with all that momentum from a good top with a high probability trend trade. Let's see if it makes it to Fibonacci support, just for grins. So I'm going to ask you guys, are there any questions about the high probability trend trade? Are there any questions about momentum, a clear path, or an entry? The easiest way to eradicate any questions is to use this drill right here, guys. This is your weekend homework. It'll take you 2 or 3 hours. You can probably do it drunk if that's your thing. Take 25 pictures of strong triggers. Annotate them. Take 25 pictures of week of a clear path of terminations. What are we doing? We are becoming familiar with both sides of the coin. When we have an advantage, when we don't have an advantage. Go take pictures of entries. Go circle those tails. See how they line up. But guys, the task isn't just to take pictures. You have to annotate your charts with the whys. You have to talk about why it's a great look. Why is it considered strong triggers? Why is that a termination condition? And then describe it. What's the advantage? What rules it associated with? Or even more so, what's the disadvantage? And what this does for you guys is it gets you speaking to yourself in terms of advantages. It gets you saying when you look at a chart, hold on, here we go, that I have the advantage of momentum and that my path is clear. And because it was, I looked for an area of resistance inside of those triggers. And when I took this trade, I'm developing trust that momentum is likely to continue in the direction of the trend. This you cannot do drunk. I had someone tell me once, if you can't do your job drunk, you can't do your job. And of course, that's silly, but it was funny. Um, Smalls are still below the large, aren't they, Jen? You still have momentum to the downside. So I'm going to tell you guys, I'm going to plead with you, do this. Man, JW, I'd probably do it better drunk than hungover. The challenge with me is it takes one drink to get me drunk these days. I'm not much of a drinker. Um, I used to be really good at it. But if you do this drill, so this is for Maddie, for Paul Flowers, for Troy, for Erla, while you're still going, right? For you guys that are really starting, Greg, I know you had to leave. For you guys that are really trying to come to grips with this very simple, highly advantageous look, right? Go through and do this drill. Come back to me on Monday and tell me that it was useless. Tell me that it didn't help. Tell me that it didn't give you anything of an advantage, and I'll stop teaching it. I'll stop teaching it. I'll say, you know what? I was wrong. You guys were right. And I'll quit doing it. But if you can go through 25 pictures of each and tell me that you aren't a better chart reader because of it, I don't, it won't happen. It won't happen. So that's why I do that. Can you guys hear me? Give me a Y if you can hear me so we know if it's just Grant or me, please. Awesome. Cool. Paul, I'm going to hold you to that. All right. No more Ys. Grant. Reboot. And true story, Paul, is it took me about 30 minutes to do all of this work right here. It only took me about 30 minutes on a Sunday morning because I'd asked everybody for about 2 weeks to do this and nobody did it. So I said, well, let me see just how arduous a task is it? And it took me 30 minutes to get a minimum of 10 in each column. You don't have to do it all at once, guys. Break it up. So Paul, I love that. Give me 25 pictures of strong triggers. And even more so, let me do this for you. And this is a great segue. Thank you for that. I dropped that little task in the room for you. Go through the KISS plan. And whoops, I'm clicking everything right now. Sorry. I'm giving you guys a high probability trend trade to recognize your entries on that small chart, knowing the conditions, what you're looking for, odds favorable. So Paul, for you, as you go through, I want you to do this. I want you to take this checklist. It's the exact same checklist, but it has pictures of what a termination that reverses the market looks like, of what momentum is. So Paul, your job is as you're taking pictures of strong triggers, is maybe even print this picture out and put it on the desktop and make sure that you're using the language and make sure that you're getting the look rights and make sure that the separation is there so you can begin to police yourself as well to give you that best of the best look, guys. This KISS plan that I'm going to give you guys begins with the entry for the high probability trend trade. This is also a checklist for it right here. I've never had anybody in the history of this checklist do worse than 70% in their trading. And I think that that's a powerful statement, right? If the goal is to get paid, and through patience and chart reading, you can get paid 70% of the time, that is a pretty good business model. If you are a big league ball player, that's a $20 million a year contract. So print this out, put it on your desktop, police yourself. And then the same one that I just showed here, take that same checklist with the pictures so that you make sure that you associate the looks with the advantages. And then put it together to create your trading plan. For you new guys, as you're learning to read the charts, your trading plan should revolve around the high probability trend trade. This plan is a stepping stone. This plan is let's turn you into a chart reader so that you can learn to swing this hammer and build whatever you want. It optimizes your chances of success with the high probability trend trade. And I'm going to tell you guys right now, there are people in this classroom that have funded trading accounts using only the KISS plan. There are people in this room that have been consistent for a long time using only the KISS plan. And what I find is it's typically our desire for more. It's our greed. It's our desire to catch every move instead of the best moves that tend to pull money out of accounts. So until you're consistent. And until you're good at your chart reads, until you're comfortable and it becomes effortless, focus on the best of the best. And then through simulation and study, class feedback, continuous practice, you're going to create a plan that's tailored to your personal goals, and it's going to be based on your experience reading the indicators. And that's a fancy AI generated way of saying, guys, when you're a chart reader, you're going to see stuff. You're going to see stuff that creates advantages. You're going to see stuff that allows you to manage looser, more aggressively. But if you don't go through and learn the very basics first, you're going to struggle. If you're trying to hit a 90-mile-an-hour fastball and you never played t-ball, you're going to be the most striking out 8-year-old in the lot. But if you learn how to keep your left arm straight, how to not chicken wing the right arm, keep your head down, swing through the ball, compress it, guys, you're going to start hitting birdies as a result of the process. So focus on your entries. And the most important thing for new users, and Ron, thank you for that. Guys, Ron tells you every day, you must learn the high probability trend trade first, and then you'll see other trades. Ron's gone through it. Ron came to me on day one, and I'll tell you what, Ron is an ass-kicking mofo now, and he's got a very solid plan that he's built on his chart reading. You've got to focus on your entries first. You've got to get in at the right spot because great entries create manageable trades. And the easiest way to avoid getting blown out, beat up, and dejected is don't fight the large chart, guys. And this is your path to financial suicide. And it is suicide. It's self-inflicted because you do this to yourself. Trading against strong triggers on the large chart is a horrible way to try to make money. You're going to get run over more often than you don't. And you're going to be tempted to fight them. And every now and then you're going to win. And you're going to post that in the room and you're going to say, Mark, you're absolutely full of crap. You can fight strong triggers and win. Maybe you can once or twice. But can you do it every day consistently for the rest of your life and create a business based on it? Trading in determination conditions is the second most popular mistake we all make. And it is one of the reasons people lose an awful lot of money. So when you're trading the KISS plan, don't fight the large chart, guys. Avoid temptation. Learn to be patient. Define your entry because your entry is going to create a manageable trade. Your management plan as a brand new user should be just as simple and focused and if-then as your entries because let's be honest, guys, we're learning to read charts. We're learning right now to recognize the best of the best, to give ourselves this advantage. And you will, I promise, you will. Elvis, I see 7 charts and no rules, brother. Are they on there? I can't wait because I love your trading. We'll check them out in the second hour. Your rules, your ability to read charts are going to make it so that you can manage trades. So your very mechanical, methodical management plan, guys, it begins with a great entry. It begins with getting in where the market is most likely to continue. It begins with you getting in at the point of resistance inside of favorable large triggers. Because when you get in there, you know where the market shouldn't go, and that's where your first stop's going to be, guys. It's going to be very methodical. You're going to put your stop up here, and you're going to say, you know what? They're going to have to come take my money. I'm not going to do anything else. They're either going to take my money or they're going to give me a reversal bar. And if they give me a reversal bar, I'm going to reduce my risk a couple ticks above. And I'm going to sit on my hands again, and I'm going to do absolutely nothing because I still have the advantage of momentum. I still have a clear path. I've taken the best of the best entry, and now it's starting to do what I want it to do. So once again, they're going to have to come get me. I'm not going to jump ship early because I'm learning to come to terms with my indicators. More often than not, it's going to hit your first target, and that's only $100 in the distance. And the $100 in the distance, so Elvis, pattern trade. What's your pattern? 3 tails, all higher highs, lows. Consolidation begins. Okay. That's awesome. That's great. That's one chart. That's an 8-range chart. Here is 1, 2, 3, 4, 5, 6 charts that don't show me where you went long. They don't show me where you took profits. 38.75, you're making me do a lot of guesswork. 38.75, I don't know, this chart says up, this chart says down, this chart's going sideways. Do you see how this creates challenges for me? You're forcing me to find your timestamps, 8:43. So at 8:43, it says up. At 8:43, it's into a termination with weak triggers. At 8:43, the smalls are below the large. At 8:43, the smalls are flat, but they're above the large. And at 8:43, I love the look on the 34. Do you see how this creates challenges for me? And I know that we do this a lot, right? So Elvis, what's your question? What critique do you want from me on this? Did you follow your rules? And did you write your rules on the chart so that I can hold you accountable to them? When you wrote, where did it go? Hold on. When you wrote pattern trade, this is the only chart I had to operate from at the time you took the trade. Why is that a signal? What are your rules? What about this? 3 tails, all higher highs, 3 tops, all higher lows. What you've done is you have described a termination condition right at a fib, and you've described a termination condition right here. You've defined a beautiful range, and then you went long from the middle of it. Does that make sense? And you're saying that it's an overall uptrend. And I'm not trying to knock you, Elvis, but I'm a pretty good chart reader, but I struggle a lot trying to figure out why you did what you did from this chart. And I struggle a lot. What's the pattern? Because you described 2 patterns, 3 areas up, 3 areas down. Why didn't you go short off resistance right here? Do you see how? So what made you go long? If this was the only chart that you used, why did you go long into 3 divergences at resistance instead of short into 3 divergences at support? And Elvis, I know you have a plan. I know that you have a plan, and you said that you followed it and you followed your rules. I'm not sure that you need critique because I don't understand your charts at all and your rules aren't clear to me. And guys, this goes back to, I want to see what you're doing, man. And if you just, okay. So let's do this. And Elvis, we do this about once a month. Three divergence from a high is a term. 3 divergence from a low is a term. Smalls down, large up is not momentum. Not trading from an area. So Elvis, this is my chart read. This says no longs, this says no shorts. This says you're not trading from an area, so I don't even know where your stop would go. And this says that you're trading into a termination condition without even having the advantage of momentum. So here's the chart read, right? But you disagree with it because you're seeing something completely different looking at 7 other charts. And this is where, in this classroom, guys, I implore you, if you're going to take a trade that goes against high, if you're going to trade into a termination condition without momentum, tell me why you did it, right? What made you think that these 3 divergences were less important than these 3 divergences? What made you feel like this area of resistance didn't have a chance to break or is going to grow, but this one is going to hold, right? So this is kind of where I'm going with this. I can't help you with this chart. I don't understand why you did what you did. Uh, that's this is a lower low. There's a pivot, and then this one is actually lower than that, and then it goes higher. And then that was a higher high, but then this was a lower high. So Elvis, I don't want to learn your trading plan. I want you to send it to me and I'll hold you accountable to it in the room. But it's not higher lows. That's a lower low. And it's not higher highs. That's a lower pivot. There's even divergence from it. So if I'm reading your chart the way I teach chart reading, I have to respectfully disagree with you. But because I understand that you have your plan and it revolves around all the information in the world and you know how to discern it all, then outstanding, great job. Elvis, thank you for that. Thank you for posting. And I apologize that I can't give you a solid critique that you need. Let's get back to management, guys. Entry, first target, $100. Keep it simple. Second target, $200. Keep it simple. Get paid. Get used to trading with advantages. Get used to trading from the area. Get used to trading when everything agrees, because that's when it's easy. And you're going to get to the point to where you have this amazing plan that doesn't make any sense to anybody but you, but that's from your chart reading, right? And if you need help developing that plan, I'm more than welcome to. I'm more than helping. Elvis, it's not going to do you any good. You know your plan. That's your trade, brother. I love it. And Ron will tell you, I'll be the first person to admit that some of you guys take trades that give me absolute heartburn because I just don't understand them. But if you can go through and create a case that's logical for me, then hell, I might steal it. I've stolen some of Ron's trades and had a great deal of success with them. But I'm using divergence pivots to recognize challenges, right? And there's one, and then there's one that's lower than it. And the third one is higher, but the third one was lower here. So I've got the perfect termination condition pattern right here, and I've got the perfect termination condition pattern right here. And for those of you that are learning to read charts, does that make sense? 3 divergences from a high says don't go long, and 3 divergences from a low says don't go short. And then if you're gonna, it's okay to wait for it to break out and take the trade. But guys, what Elvis is doing here is he's reminding you that when you find the looks that jive with your brain, you'll take trades that make perfect sense because they are your rules. And that's okay. And that's all right. But if you present in the room and you force me to chart read, I'm going to tell you that you traded directly into a termination condition at resistance. And I feel like this is a trade based on basic chart reading that has less of a chance of winning based off of that chart than it does losing. So I apologize for the digression, guys. Keep it simple. Keep it focused. 2 charts is all you need in the beginning. 3 rules is all you need in the beginning. Become a chart reader, and you'll be able to take these trades that you see other people taking. You'll be able to recognize these trades that you see other people taking. And look at that. They made it. They made it. There was a lot of nonsense in there, but they made it to the fib. And I don't know if you held this one. I don't know if you held this one. I don't think I would have, not with this. But they did make it right to the circle. Elvis, man, have a great weekend. You know I love everything about your trading. I just don't understand it, and I can't decipher it because it makes sense to you. And a lot of times I've got to focus on the other 39 people in here and make sure that we're not confusing them too much. So I always go back to the very basic reads when we do this. And man, I'll tell you what, DM me, send me a message, show me some stuff, teach me your rules. I'm very open to learning them. Cool. Cool, cool, cool. And guys, that's just a pretty good example. So even if you exited, no reason to exit on one divergence. Two divergences doesn't scare us. It pulled right back to the mid-band. You guys see that? Two opportunities to get into this short trade. And then if you're using that very pragmatic approach, that's okay, Elvis. I've taught a lot of millionaire traders, and I taught them chart reading, and that's what this room is. This room is the let's learn to read our indicators chart. The other room is the hey, look at what a badass I am room, right? This is the learning room. This is the training wheels room. This is the learn to read your indicators room. And the other one, guys, I promise you, once you are a freaking rock star and you have your plan, go to the traders room. Go show off a little bit, right? Get in there. Show the world what you learned. Because that's the look how I learned to use the indicators, and this is the hey, look how I'm learning to use the indicators. So, sorry. Guys, I want you to see this. If you entered, let's take the picture. Let me make sure I get the timestamps in here. If you entered at, what is that? We'll call it 11. At 91, that was your $300. And I don't know if you guys are doing this, but per the KISS plan, you got paid. And then when this pullback came to resistance at 02, 03, down here at 83, you made another $300. Does everybody see that? From the very basic standpoint. It's okay to get in and out. It's okay to take profits. It's okay to get paid. And the amazing thing is in this window right here, you got paid twice on the same money. You kept it very pragmatic. You took profits. You went break even. You got paid. You got out. Your rules were met again. You took profits. You went break even. You got paid. And look at this. By the time the nonsense happened, you were already up $600. Well, you might have gotten stopped out. I guess it depends on where your stops were, Paul. But if you got in here, watch this. If you got in at the higher point, right, and you decided to stay in, and this pivot didn't stop here, and it went all the way up here, you're going to feel a little bit like a jackass that you just gave $700 back, don't you think? Remember that the goal of trading is to get paid, guys. And you're absolutely right. So let's go and use the very basic rules, Paul, for management. If, let's pull the picture back up. I love these questions, guys. These are great. If I know where the market should go, well, then I know where the market shouldn't go. And there's your initial stop, right? Reversal bar. So, Paul, if you're looking at it and you're saying to yourself, man, this trend is down. It's awesome. It's great. I want to hold. I'm not going to exit here. Well, when the market starts pushing up, you got to say to yourself, where shouldn't it go? And that's about a logical stop, right? 4 or 5 ticks beyond those triggers, beyond those one-to-ones in them. So there's your first hold. You're going through. You get a reversal bar down. It makes sense. Let's trail behind the reversal bar the same way we did up here. So at this point, you're locked in a little bit. And then you start to get another reversal bar. And you go through the process and you say, all right, here's my triggers. Here's my area inside. Where shouldn't the market go? Well, the market shouldn't go here, right? And you get stopped out. And when you get stopped out, your large triggers are rolling, right? And it's kind of ugly, and maybe you don't get back in there just based off of it. So either one is okay. You can get in and you can hold forever, or you can get in and you can get out, or you can say, with this momentum and stuff like that, hell, I'll keep a stop at break even and let's just see if we get to the fib. And there's people that employ all different kinds of strategies, Paul. And it has a lot to do with our pain tolerances. Um, can you sit through? That's from 81 to '08. Can you sit through $270 of drawdown when you've been up $700? Are you okay watching that go against you? Not everybody is. Some people are. Some people will say, I'll get paid, I'll add back on, I'll get paid, and I'll leave one of them out here. And maybe we'll see if that fib gets hit. And there's a million different ways to do it, Paul. Um, and just to throw that silly cliche phrase out there again, the more time you spend in the market, the more time you spend in the market, the more it's gonna be easy for you to create a plan. The easier it'll be for you to understand when you're willing to hold and when you're willing to not hold. So there's a sorry cat lovers. There's 1,000 ways to skin a cat. And this is why we talk about at first, let's take the best entries, right? Because at least then we got a fighting chance to get paid, make some money, create some confidence. And then we can begin to employ our management plan that uses our chart reading. Does that make sense? Was that a fair answer? That crude trade was trade management, and you realize it's okay to get in and out. And that's what I think. In and out. And let's do some simple math together, ladies and gentlemen. Let me pull up my calculator. So let's do this. If I win $100 in a trade, that's it. The best I can do is $100. And I do it 5 times a day. It's still a $500 day without hitting a home run, isn't it? And then if I do that every day, and there's 252 trading days in a year, that's a $126,000 a year based on 5 base hits. Pretty cool, right? And that $500, doesn't it spend the exact same as holding for one $500 trade and having to suffer pullbacks and retracements and all that sort of stuff? And guys, the wonderful thing, and you realize this the more time you spend with the software, is that you're going to be so stinking good at this that you'll be able to take these small hits. You'll be able to say, hey, we're cruising and it's not the best, but look at that clearly defined area. Maybe I'll give it one more shot, right? Maybe I'll give it one more shot. And it is, Bob, it's money ball all day long. And my job, my whole sole purpose with Nexgen, ladies and gentlemen, is to get you to the point to where you can recognize advantages. My whole goal is to get you to where you recognize the best of the best so that you can begin to fudge your rules a little bit, bend your rules a little bit, break your rules a little bit, to get you so focused on having advantages that you recognize when they go away, that you can manage these trades, that you can make money and get paid in a million different scenarios. And when you say to yourself, I do have momentum, but I have that not favorable large triggers, right? I have one area beyond the correction point and I have one area stuck in between the two. Maybe that's not my best trade. And some of you may have taken that one. And then some of you may say, and let's see what this one looked like just for grins, that with the potential to break and all that momentum, let's see what it looked like. If I scroll back. And that was pretty ugly, right? Probably not your money. And that one might have been. So you have to be able to make decisions on your own. You have to be able to formulate a plan. You have to be able to understand what it's going to take to get you in and what it's going to take to get you out. The easier you make that as a brand new user, the quicker you're going to get to the point to where you can find these other advantages. I've seen it. I've been doing this. I've been training traders for 3.5 years. And the people that look for everything rarely find everything. And the people that look for the best almost always find it. So are there any questions? I'm going to ask one more time and then I'm going to go run a lap. Any questions about momentum, a clear path? Any questions about entry areas? And I'm going to do this one more time, guys. I'm going to give you the chart reading 101. I'm going to give you both high probability trade checklists. I'm going to give you the PowerPoint that I use to teach the classroom in the morning. One more. I'm going to give you my spreadsheet that already has a great start for you on learning those looks. So, guys, take all of these things, download them, put them on your computer, study them, learn them, focus on them, ask me a million questions about them. And we're going to get into the second hour. We're going to go ahead and start looking at the charts that you guys have posted, and we're going to revolve around advantages, guys. That's all we're going to do. We're going to revolve around the idea of momentum, clear path at an entry area. So if your chart is way out of sorts and doesn't make sense to me, I'm going to resort to what I understand. I'm going to read your chart. If your rules aren't there, I'm just going to go back to these three things. And it doesn't mean that it's not a good trade. It may mean simply that I don't understand your trade, that your trade has so many advantages gone that I'm having trouble finding your entries and understanding it. And if that happens a lot, then I need you to be a little more clear on your rules, because I'll always go back to what I see and what my read is. So, guys, I'll be back in 5 minutes. Go stretch your legs, and we'll finish class strong on a Friday. All right, guys, can you hear me? Okay, cool. Discord's kind of lagging a little bit. We're gonna go through and we're gonna look at some pictures. We're gonna talk about some chart reads, and I'm gonna tell a story while I scroll up to the top of the charts. When I was a kid, I played Little League. I played baseball. That was my thing. I loved it. We had a pretty good team because we'd grown up playing together, and we were in a playoff game once. And this is relevant when we talk about why I read charts the way I do. And it was the ninth inning, and it was bases loaded, and we were up to bat, and it was tie game. I mean, it was everything that you could ever hope, everything you could ever hope for in a playoff game. And Scott McCall came up to bat. I still remember his name, 45 years later or whatever, 40 years later. And Scott couldn't hit, and he ran like molasses in January. And it was the worst case scenario um, for us. And the pitcher threw it, and Scott McCall got hit in the head with the pitch, and the winning run comes in, and we win the playoff game. And Scott loved to jokingly tell people that he drove in the winning run in the game, and it was funny because the reality is that he got lucky, right? He got lucky that he got hit in the head, and when he got lucky getting hit in the head, it turns out that we won, and traders love to do this. And guys, I'm trying to get Discord to open pictures and it's not, so I'm gonna have to go through and reboot it. Traders love to say, "But look, I won. Look, I won. I made money." And man, Scott McCall couldn't go and throw his head into a pitch every game. Um, nice, Grant. He couldn't do that every game because he'd get a concussion, right? So just because his results were fantastic for getting hit in the head that one time doesn't mean that that's a path to success. So when I look at y'all's charts and I see you fighting everything and you tell me, "But Mark, I won," then I have challenges with that, and I'll tell you that you got lucky. So let me reboot Discord again, guys, because here we go. It's not messing with me, or it's not working with me. I'll be right back. All right, can you guys hear me? I'm trying to come back in here. Let me get my picture up, and hopefully I can open pictures this time. I was clicking frantically on pictures, and I couldn't. All right, so here we go. We're going to head up to the beginning of the day. We're going to take a look at them. I'm going to start talking about advantages, disadvantages. Guys, I do have to scroll up and then come back down. So what happens is I miss questions for a second. If I miss a chart, if I miss a question, make sure you let me know. Erla got us going this morning, and Erla said, odds favorable momentum. And that was a trend trade right here, Erla. That was a perfect trend trade. And all that momentum breaks the areas, so you get in. And with the loss of momentum, you exit. And I absolutely love that, Erla. You are focused on momentum and a clear path, and you're not willing to hold and hope forever. When that momentum goes away, so does your trade. And I think that is outstanding management. And it shows a very definite lack of hope, because hope is an absolute killer. Rather be lucky than good. Well, Richard Petty's not with us anymore. That legacy may have died with him. Luck is great, right? Luck is what do they say? Luck is where practice and experience meet or something like that. All right. Haji, good top, love it. Momentum, love it. Perfect entry. And you get paid. And then you get another perfect entry. And you're like, man, let's double up. And you get paid again, I think. Get paid, re-enter. The reversal bar gives you an opportunity to put your stop right behind it. Both got first target, both break even. That's about the easiest $200 ever, Haji. What awesome management. Playing with those advantages, taking the perfect entry, believing in the reversal bars and the movement, and just awesome. And then split triggers. There you go. That's true, Maddie. Split triggers. Guys, one of the things that I'm pretty good at is, or maybe it's a curse, is I don't forget stuff. So when you post in the room, I remember what you're posting. When you post in the room, I remember the patterns that you're trading. I remember what your thing is. Like, I know which one of you guys like to jump in early, and I know which one of you guys are going to cut ties early, and I know which one of you guys are going to jump in on split triggers, hoping that it works out for you. And one of the things that I do, and I do it without hesitation, is I go, hey, Haji, split triggers is producing more losers for you. Is he? Good for him. I always like Richard Petty. Split triggers is producing more losers than winners for you. Maybe this isn't your thing. And Haji just said, hey, you know what? Let me go back and study my trades. And when he did, he's like, holy crap, you're right. I lose more of these than I win, which means that there's not a statistical advantage, which means maybe this shouldn't be a part of my plan. And Haji, I've watched you not give money away on that look a lot this week. And then Josh, everything says up, the momentum is strong, the entry is perfect, and the stop is maybe a little bigger than it needed to be. But other than that, it's perfect. It's 100% rules-based. So where is that? Guys, this is what I want you to do if you're a brand new user. We won't even look at another chart. Did I have odds favorable? Absolutely. Rule number 1 is met. Did I have a clear path? It would appear that I did. Did I have an area of entry inside of favorable large triggers? 100%. Josh knew exactly where that market was likely to continue if it was going to go. And here's the one thing, Josh, is you put your stop on this trade. I'm right here, right? Because if it goes below all this stuff, it's just not doing what it said it was going to do. It's not fulfilling its part of the obligation to continue up. And that stop is maybe a little further than you needed it to be. I understand why you did it, but look at where it's at on the large chart. And sometimes this creates a little perspective for people. You said that if the large chart gets all the way back to here, with the small triggers down, that you're willing to stay in that trade. And maybe looking over here, maybe it makes sense in the moment, right? But for me, I'm saying, okay, this is the area that I'm expecting to hold as support at 1775, right? And you got in right at it. Absolutely beautiful. Man, if it drops down to 1650, maybe I don't want to be in that trade anymore. Maybe I'll look for the next best entry. But a lot of times for people, what you'll find is that you're so good at this that you'll be able to lose $50 and then take a winner rather than losing $250 on a bigger loser. So I like everything about it, Josh. I would have been in that trade with you, and I would have lost it right next to you because everything about it is picture perfect. And those are the trades that even though it lost, you're going to feel comfortable taking the next one because you know that it wins more than it loses. And then here we have termination, second lower divergence, momentum, pull back to the one-to-ones inside of triggers. And absolutely, I agree 100%. You put your stop inside of the correction point. And guys, that'll get you a lot. Putting your stop inside of the correction point will get you. When that divergence prints, when it's 50-50 on the divergence low, it may push higher, and just being able to expect that helps out. JW, it's a great look. It's an awesome trade. I just think that your stop was just a little tighter than it needed to be there. And guys, you'll learn what stops work for you and which trades are appropriate. And you'll also learn that when you have momentum and a clear path and there's absolutely nothing in your way, you can find other ways to make money. And I love this, guys. That is a $100 trade with momentum. It's a $100 trade with a clear path. It is a beautiful trade. Odds favorable, potential to break, perfect entry, reasonable stop, out here, and then making it again. Paul, great trade. Yeah, that's okay, JW. It happens. It happens, man. I'll tell you from my own experience is I've taken trades. Guys, give me a Y if you can hear me. There we go. Too many Y's in there. So guys, if you ever can't hear me and you see a flood of Y's come in after you say that, it means that everybody else is pretty cool with it. Paul, momentum, potential to break, perfect entries, create manageable trades, beautiful stop placement, and just getting paid. What was that, $300 on a 2-lot, Paul? Easy money, no stress. He nailed a stop. The cool thing is if you employ the exact same strategy, it's $600 on a 4-lot, isn't it? And it's $900 on a 6-lot, and it's $1,200 on an 8-lot. And what does that mean? That means that you don't have to catch more trades. Eventually, just let the profits add a couple contracts, do the exact same thing, and increase your revenue. I always ask people that trade the NASDAQ, do you need the NASDAQ to reach your goals? Do you need that headache of the NASDAQ to reach your goals? And a lot of people don't. They can reach their goals just fine. And then Ron, when the third divergence printed, you said that's probably going to go test the mid-band. And man, Elvis, if you can hear me now, this is one of those trades. This is one of those trades that gives me heartburn. For everybody, I don't mind saying it. Ron knows it. I tell Ron. This is a trade that fights momentum and a clear path and uses small chart shenanigans to take advantage of tiny retracements and fluctuations. And guys, if you try this without doing due diligence, and I'm going to tell you right now, and Ron, I'm going to give away your secret. Ron worked on this trade for months. He studied this trade on simulator for months, and he was able to calculate whether or not, following a very strategic plan, he could win this one more than he lost. And I'll tell you what, to the basic onlooker, it looks like the worst thing you could ever do to yourself. But to Ron goes, hey, look, my rules are met, and I know that I have a shot. I would never, and if Ron said, hey, Mark, do me a favor, critique this chart, I would say, Ron, you had an amazing top with 3 divergences. The market's going down. The momentum is the fastest. The path is clear. And you went long. Why do you hate money? True story. That would be my read instantly. Why on earth? What did money do to you? How did money hurt you, Ron? Let's talk about it. Because this is the one that if I tried to take, somewhere in there would be a misunderstanding. Somewhere in there, I would either miss a divergence or a trigger location or something like that. Do you notice that on the divergence here, he didn't go long? Most of you won't pick up instantly that the small triggers are still down and never rolled, right? Most of you won't pick up that price is on the wrong side of it. And it's kind of cool because there's these tiny little nuances that are studied, that are practiced, that are repeated until the idea that there is, in fact, a statistical advantage, and that's how it becomes a trade. So I love it. I love everything about it. I won't take it. It scares the hell out of me. But it's a good one. Anointed. All right, Josh. What are you doing wrong? You had momentum, right? So, Josh, this is more of a pattern thing. So, Josh, yeah, let me know when you're off, and I got you. So we'll go back to Josh's in a minute, guys. Not a lot of pictures being posted today. That's okay. Let's see. Hey, Haji, we'll come back to it. Haji, if you had to use 2 words to describe what may have gone wrong with this trade, what would it be? While I open up Joel's chart. Good bottom, strong triggers. Amen. Perfect entry. Gosh, Joel, beautiful. And out at trouble. Hey, Joel, can I ask you, because you don't talk a lot in class anymore, like you used to, has it really gotten as easy as you're making it look? Have you found that comfort level? Because it looks like you have. From the outsider looking in, it certainly looks like you've gotten to a point in your trading where you're just really confident with what you're doing. And you're showing me so many amazing trades and so many great chart reads. And I know that it's a process. And I just want to make sure that you're taking a minute to celebrate it, because I'm celebrating it over here. And then that's the one we talked about here, Grant. Not the best momentum, but a clear path and a clearly defined area. And it was pretty easy, right? And it was pretty easy. Notice that the momentum isn't great, guys, but he has clear path and he does have a well-defined entry area. Don't worry about the newbies, Joel. They'll get there if they follow the path like you did, if they do the study. This is awesome. And that was easy and effortless. Great job. Heading into the weekend, feeling good. Paul, first time in the South, you asked for directions. It was like understanding the chef and the Muppets, another language. Man, that's how I feel about Northerners. Man, we took a trip to Boston once. I took the family up there to hang out, and it was interesting. When you lose your car keys, it means that your pants are gone, your khakis are gone, not the keys to your car. It's different accents, huh? That's okay, Joel. For which one, Paul? You're welcome. I don't know what it was, but you're welcome. Oh, the Boston car keys. It's true, though. Oh, you're from New Orleans. Right on. Deanie's in New Orleans is one of my favorite restaurants ever. Ever. Yeah, probably. Not just north, but coastal. So I don't know if you've ever been there, Paul, but Deanie's in New Orleans has the best barbecue shrimp. Um, and maybe it's just because I was a tourist, but I loved it. All right, Rob, are you with me? Are you trading? Which chart's your entry chart? Small chart? Here's the short version. We circled this yesterday. Let's go back to it. Let's do this again because this is a great lesson for everybody. This is crude oil yesterday morning. Let me pull up that very same crude oil chart. All right. So let me back up. There it is right there. Okay, so that was, is that right? Is that the one, Rob? What time was yours? Yep, that was it. Cool. All right, let me back this one up to it. And guys, this is a good lesson on the difference in charts. So thank you for bringing this back up, Rob. All right, so this is the picture that Rob put in the room. And the question is, hey, Mark, because everybody says, hey, Mark. Hey, Mark, how come this bar is at 7-Eleven, right? And the timestamp seems weird because it looks like this one happens at a different time. So I want you guys to see something. Whoops, let me get that off of there. I'm going to put a box around this bar, that one bar. The high of that bar, we'll do a vertical line. The high of that bar printed right around 6:40 in the morning. The next bar that printed on the large chart, whoops, wrong one. The next bar that printed on the large chart, I can do this, I promise. Printed at about 7:15-ish. Let me make that bigger. 7:18. So this span right here, Rob, is 45 minutes long. Does that make sense? That one bar on the large chart took 45 minutes to print. So it wouldn't make sense that your timestamps on the large chart look exactly like all the information here, because depending on how you have your chart set up, right, if you're squeezed a little bit, it looks weird, right? That doesn't line up. That doesn't make sense. So what you're seeing is the dissection of the bar. That's why it doesn't look like your timestamps line up. But here's the other part of it. If I circle, because you're wondering, I can't line up the tail on the large chart, right? I can't line up that tail. How am I supposed to enter the market? Rob, we don't trade the tails on the large chart. We trade the pullbacks on the small chart. And if you wait for the tail, you're going to miss it. But look at that. If I circle the pullback to those 1-to-1s right at the triggers without divergence, with these cranking up, it lines up with the bottom of that bar. The problem is, Rob, is you're trying to line up the tail, not the entry rules. Does that make sense? The circles line up perfectly. And the challenge is probably that you're going, oh, I need this tail, I need this tail, I need to figure it out, when you should really be focusing your attention. If your rules are met over here, you should be focusing your attention over here and not worrying about the tails anymore on the large chart, because the reality is on the large chart, once it looks like this, without the tails, that was 942. Once it looks like that without the tails, whoops, your small chart probably looks like this. So you're waiting for the reversal bar, you're looking for the area inside of triggers, you're entering the market, and your large chart still looks like this. There's no tails, it's just fluctuations. And then the market hits it, and then it goes down. And once it breaks below that low that started the pullback, now you have a tail. Does that make sense, everybody? This is why that refinement process is so advantageous for you guys. because it gives you the opportunity to not have to wait for tails on a larger chart, to not get into the moves late. You can literally pinpoint exactly where the market is most likely to continue before the tail ever forms. Right? This bar is still going. That tail, if it goes down from here, that tail will never exist. This is just one bar. Did that help a little bit, Rob? Does that help you? So right now, S&P. Tail into momentum. I'm not trading the tail. I'm trading the area of support, right? So you can see how if the market goes up, there will be a tail. If the market just goes down, there will never be a tail. There'll be a reversal bar. So I don't trade tails. Guys, my focus is areas of support inside of favorable large triggers. And Roku, you're saying there's so many opportunities to take home profits. You're saying with momentum on both charts, you'll just trade momentum, get out, make money, call it a day. I like it. This one's a little iffy, Roku. I'm not going to lie. You're trading directly into one-to-ones. Trading directly into one-to-ones. But of course, your charts don't line up. That's 1032-ish, and this is already 1056, and maybe all this sideways just kind of held out. But you've got odds favorable on the small chart. The small triggers are up over here, and you're saying, let me grab a snippet. I like it, and I know that you have a good plan. I know that you've got your style that's working great for you. And then, guys, notice how the mid-band was on the wrong side of the correction point. Didn't have the best momentum. You got to be able to figure that stuff out at a moment's notice. In class, well, so Paul, I think this is one of the biggest things, man, is, and correct me if I'm wrong, I talk about every day, that when your correction point, or when your area is on the wrong side of the correction point, you've lost your advantage, guys. We expect price to return to the triggers. And then we expect price to bounce off of an area inside. And the second you get to the other side of them, your trades become more risky. They become less profitable. They become lower probability. So Paul, and then Josh, I got you right after. Here, let me grab this picture for it because it really shows it up. And you don't have to know the math. You don't have to understand any of the math of it. But here's the deal. We'll just do it like this. I'll blow this up. Your trigger lines... Oh, nope, this is actually a different Paul. We've got a lot of you guys. So trigger lines, Paul, are moving averages, right? And it doesn't matter what makes them, why they're moving averages or anything like that. So they're just moving averages. Does that part make sense, Paul? That's the first part of understanding this. Is that moving averages, I expect price to return to the triggers. I expect price to come back and close the gap to the triggers. It's the regression of the mean. I think somebody told me it was called once. So Pineski, are you with me on that one? I expect, because of just the correction in the wonderful world, I expect price to come back to triggers. That's it. And if you go back and you look at the market, even on the large chart, price always tends to come back to the triggers. No worries. So when I say correction point, when the market moves up and down, it tends to come back to the triggers. And the triggers don't necessarily stop it. Do you see it? price breaks away and comes back. Price breaks away and comes back. Price breaks away from triggers and comes back to triggers. Does that make sense, everybody? The triggers are moving averages. So when price accelerates away from them, it tends to pull back. That's all I'm saying. So why do I call the triggers a correction point? Because that's where price pulls back to. Can you guys give me a why if that makes sense? Sometimes we use that correction point to identify the gap theory. But when price accelerates away, I expect it to come back to the triggers. That's all it is. Does that make sense, Mr. Flowers? Look at this. Price pulled away and it came right back to the triggers. Cool. So I use that idea of it's a correction point. Right now, price is accelerating away from the large triggers. At some point, I expect it to come back to it. So when I look at a smaller chart, the exact same thing is true, 100%. When price pulls away from these triggers, I anticipate that somewhere inside of these triggers, price is going to come back to it. That's its correction. That is price returning to the mean average. Are we good so far? Is everybody following me? And guys, this is stuff that I made up in my head that makes a lot of sense, that has a little bit of math behind it. So I consider these triggers are where price should pull back to. That's all. That's all it is. And this is why I look for my triggers first. When the rules are met, I expect areas, fibs, midbands, one-to-ones inside of those triggers to create a bounce. Does that make sense, everybody? Are you with me so far? The white box is where I expect price to return to, but I don't expect these triggers to ever stop the market. And this is why we rely on having areas inside of them. So not only do you hit a correction point where we expect the price to go, but what you also do is you give it something very solid to bounce off of, something to continue with all that momentum and that clear path. Can you guys give me a why if that makes sense? Sometimes I say things and you guys and I assume that you understand me, and if you don't, please tell me. So let me go to this right here. If your correction points, if your correction point, when they're one on top of the other, very, very strong, trending together, turns into correction points, two different spots where that market may return. Do you see how this kind of decreases your ability to have some accuracy? Do you see how it creates a little bit of indecision? Because you've got an area here, but you don't have any areas beyond there. And this area isn't at all in the correction point. It's hovering between two correction points. And then to the point we're making is once they're beyond, hasn't that market already zipped past where we expect it to go? And guys, I'm telling you right now, this will keep you out of a lot of crappy trades. This will keep you out of a lot of losers. When your correction point begins to deviate, begins to split, begins to create distance between the two, the indecision is there. I don't expect a mid-band floating in the middle of nowhere to stop the market as often as I expect a mid-band inside of favorable large triggers to stop the market. I don't expect this fib to stop the market from the wrong side of the trigger lines, but if it were buried inside of the trigger lines and those two kind of had a little marriage there, well then I expect that's the best spot for a bounce. Is everybody with me? So when you identify the correction point, large triggers, and then you look for the areas within, once it's beyond where I expect the market to go, it may create problems. So here we go again. No areas inside of where I expect it to go. My area is beyond. 5130.08 is beyond the correction point. Notice that it's also beyond the correction point on the large chart. And it doesn't mean that the market won't go down from it. It just means that your statistical advantage goes away a little bit. And as you grow with the software, you'll begin to see more and more when it's okay to take this trade, and when, as the market goes beyond the correction point, you feel as though your advantage is being lost. And it'll have a lot to do with, it'll have a lot to do with the momentum on the market, right? When it's like this, maybe that deviation's okay. When the smalls are outside, maybe it's worth a shot. But you have to understand that this is a little problematic. And it can be problematic. So this is where sometimes you wait for a little confirmation. You wait for just a little bit of, let me let the market start going in the direction I want it to go, right? Because I'm not at that best spot anymore. I'm not at that perfect entry, and I'm a brand new user, and it's important to me that I have the highest chance of success. So based on that lesson, Josh, here we go. We're going to talk about a few different expectations on this chart, and it's okay. I don't disagree with your trade, but when I'm coming from a bad top, Josh, do you remember, just from hearing me drone on every day about the same darn things, is that when I have a bad top, when I have an area or I have a reversal that's not a no triggers through termination, that mid band is my first bounce point. Is everybody comfortable with that? It's not a trade, but if I'm coming not from an area from the middle of nowhere, this is my first trouble spot, and it doesn't mean that it's going to hold, right? There's a recipe for it. There's a recipe for that mid band, whether or not it's a termination condition. But once you recognize this pattern, here we go, chart read, it puts you on your guard when you get to this area. If nothing else, Josh, you say to yourself right here, you say, this is the first potential bounce point. Maybe I'll be a bit anal on my entry. Fair enough, right? Because it's just a chart read. It's not a termination condition. So then you start saying, well, divergence printed, but one divergence doesn't kill me. I'm not super worried about that. And then you say to yourself, but wait a minute. These bad boys don't line up. There's that split between the triggers doubling my correction point, and I don't have any areas in this one, and that one is prior to the next one, and these are beyond that one. Maybe I'll wait for a reversal bar from that correction point. Maybe I'll force the market to tell me that it is in fact going to go down, because my entry is a little crappy, and I'm at that first bounce point. And Josh, I'm going to tell you right now, this isn't the stuff that you guys put into play instantly, right? This is the stuff that you have to see it a few times. But it's all patterns and expectations. And let's go through and see if we can just recreate some of them. When it's a bad top, and this is kind of cool because it happens a couple times. When it's a bad top, the mid band holds. When it's a bad top, the mid band holds. When it's a bad bottom, the mid band holds. When it's a bad bottom, the mid band holds. Do you see the pattern here? When it's a good top and it comes through, the mid band holds to the downside. Oh, no work. Jen, I haven't missed any of your charts, have I? Have a great weekend. So guys, this is pattern recognition is all it is. And this is chart reading. And chart reading doesn't necessarily mean that you have a trade. Okay, cool. I loved your crude trade. But what I do know is that when I have a bad bottom, this mid band's my first bounce point. So just for grins at 9 a.m., let's see what it looked like over here. at 9 a.m. Check it out. It's split triggers again, Josh. So I'm at that first bounce point. It's looking pretty good. The triggers are split. And man, if you took it with the reversal bar and took a small loss, I'd dig it all day long. But the cool thing is if it doesn't give you the reversal bar, then you don't take the trade. So let's check this one. Nope, that wasn't one. That's just an odds favorable that I would lose all day long. And then the mid band holds. And then the bad top and the mid band holds and the bad top. And then this is the one right here where it was split. And then that's your third divergence, but check it out. So here we get to the mid band and we get to the 50-50. Let's see what it looked like when we got to that area around 11:11 off the third divergence on the large chart. Notice that they were at least one on top of the other, giving you a pretty good opportunity if for some reason it gave you an opportunity, right? And the mid-band, large triggers aren't a full bar away, but see how it's tighter there and it continues? So there's a pretty good lesson there. And then, Paul, that's a great read. That's a termination, right? Reverse the market. That's a termination that reversed the market. And that's what I'm saying, Grant or Paul, I'd lose this trade all day long. Odds favorable, clear path from a termination. Man, if they stopped me out, they earned it because I had every advantage on that trade. Does it mean that it's a bad trade? Let's go see what it looked like. 939. Were there any indications on the chart that that one might not be a home run? Hell no. I love everything about that trade. Paul Flowers, you couldn't keep me out of that trade. A termination that reverses the market, that gives me momentum with absolutely nothing in the way. And then the absolute smallest window of opportunity, one line wide. Paul, do you see how that one fit every rule that we teach here in the first hour? And it still whipped our butts. But the cool thing is that if you put your rules against it and you look at the advantages, and if you wholeheartedly believe that this is a trade that wins more than it loses, that creates a statistical advantage, this loser becomes pretty easy to sit through. And it's not such a mind meld for you. But you're right. You called that perfect. That was a perfectly good bottom. And you had every advantage, and it just didn't work. And then that was beyond the correction point, and it lets you go a little bit, and then that second divergence pushed it up even higher. Do you see how it's not perfect and there's indecision in the market? Guys, I'm telling you, you'll find a way to capitalize on these eventually. But if you're a brand new user, embrace these very simple concepts. Embrace the idea that when your areas fall beyond, it's not as good. Bad bottom, 50-50, no divergence. Yeah, Haji, I don't disagree with you. I don't care for gold. I think gold is temperamental. I think gold overruns a lot. Um, and it's just, I think your rules were met, and I think that it was bad luck. But I see more people posting gold trades that overrun. Um, yeah, my brother told me once. He goes, gold is that hot redhead that you dated in high school. And I had her, and mine actually hit me with her truck, and I dated her again. Um, and there's just something about it. It's so enticing. And and man, gold does it. Gold does it. And every man is at least five because we keep going back. So, guys, you got to know the markets too, right? Gold has a different personality than crude oil or the ES. There's a reason that we spend so much time on crude oil and the S&P. And this one, rules kept you out of the indecision, and it may still go down, right? But your rules said, it's not the correction zone, and it negated your need to manage because you chose to miss it. And I guess this is really where I'm going with this, guys, and where I go every day. Let it be really easy at first. Let it be super simple at first. And I promise you, you're going to find a million ways to trade the market. You're going to find a million things that fit your rules, and you're going to find trades every day. And the thing is, though, guys, if something wins 70 to 80% of the time on any given day, if all you find is 4 trades, and you can only win 3 of them, right? You're still doing pretty good at 75%. And if the 3 that you win, only one of them goes the distance to 300, so you're up 500, and you give 200 back, and the best you could do on those 4 trades is $300 on that 2 lot. It's a $72,000 year. And I don't think that we talk about it like that a whole lot. I don't think we talk about it in terms of how little you have to make consistently every day to put a lot of money in your bank account every year. We get so wrapped up in, what did I make today? What did I make today? I've worked for a Tex-Mex restaurant for 19 years, managed them for 10, was a GM. And the assholes that ran it had this phrase, you're only as good as your last enchilada. And I got in a very heated verbal altercation with the vice president of the company, who told me that because one customer out of 1,000 didn't like my enchilada sucked, and I need to focus on fixing it. And guys, it's utter bullshit. If 2 of your trades out of 10 don't win and 8 of them do, there's nothing wrong with your plan. Right? It's just a cost of doing business. Not everybody can be happy. If you take 100 trades and they all look the same and you win 80 of them, you have a recipe for success. You have something that's freaking gold that you should hold on to forever. And that's kind of what the KISS plan is. And look at it. My areas are beyond the correction point. My correction points keep changing. How many of you get caught up in areas like this and give money back? Because of that one simple rule. Rule number 3 we choose to ignore. We choose to ignore that areas inside of favorable large triggers offer our best chance of success. Paul, I was the GM that I would fire customers and I wouldn't have a problem with it. Wouldn't have a problem with it. If you came into my store more than 3 times and caused a stink, I told you, don't come back. Let's take a look, Josh. Let's do the chart read together. Crude oil, technically it's a weak bottom, but where am I at? I am odds favorable, and I'm clear path, and I have clearly designed, and I don't have any areas inside of triggers. This right here is a momentum trade. If you were going to take it, so look at what happened. Weak bottom, straight to the midband, and then it pulls back to support. The triggers don't blink. Everything goes up. There's your correction. This bad bottom goes to trouble. Gap theory pulls you back to the large triggers. When this pullback happens, Josh, this is where you're going to make decisions. This is where you're going to say, okay, one of 2 things can happen. That snapback is going to be the start of more up if my triggers get above this area of support. Or, and it's very probable from a bad bottom, it may just continue right down through those triggers that are below the area. And what happens right in here is going to define which direction that market's going to go, at least for the immediate future. So what does that mean? If right here at this box, it has a chance to go up or a chance to go down. This is where you guys have to start playing if then. If it rolls and goes up, I'm going to look for longs. If it breaks below everything, I'm going to look for shorts and try to get to the next area. And that's really it, guys. But your chart reading said, this is your trouble spot. I can't go long into resistance, and I can't go short against momentum. I have to do absolutely freaking nothing. Any money made in this box here is not my money. Does that make sense, everybody? This is where I expect price to correct. I don't have anything for it to bounce off of. I'm losing momentum, right? My smalls are working their way inside of the large on both charts. Yeah, Cisco, I would, and this is just me, and you don't have to. I'll get you my templates. Let me go grab mine too. But sometimes when things don't look right, going through and doing a full rerun isn't a bad plan. But give me just 1 second, and I got you here. Templates chart. Let me take the 5-1 and the 13-2, right? Whoops. I just lost them. There you go, bud. There's both of mine. You're going to have to extract them. It's a compressed file. So what you're going to do, Paul, like if you want to give everything an enema this weekend and start 100% fresh on Monday, ooh, that's going slow. I'm going to give you 2 things here. Actually, this right here will get you. You can delete everything. You can clear out your charts, your workspaces, go through and do that NinjaTrader clean out. And this gets rid of all your workspaces. It's going to get rid of all of your chart templates, everything. And then if you go to the resources page, you can run the indicators again. And what it does is not only will it repair any issues that may be in NinjaTrader, and guys, they had an update that made it more stable, and that's in the new installer as well. But it'll also give you brand new workspaces, so 100%. So if there's anything corrupt in there, it's going to go away. And then it'll give you all new chart templates. It'll give you everything it'll be like starting day one. And it's cool. It's a cool confidence builder knowing that you came in. My triggers keep getting weaker, don't they? If I have weak triggers and all of my areas are beyond the correction point, if I were intent on taking a long, maybe, Paul, get with Jason. Jason would have that answer better than I would. I haven't been on 7 in a while. Sorry, man, I will tech the heck out of it until I reach my limit. And then once I run out of talent, I have to defer you to Jason. So guys, we're just chart reading right now. If I have weaker triggers and no areas inside of triggers, doesn't it stand to reason that the market may come back to this mid-band or these 1-to-1s or that fib? And I really just don't know. TLC, why did you take the pullback without momentum? What got you in? Which little pullback? This one? Here or up here? If you took it here and you're getting out at this one, where the momentum was still going, up here where the small triggers returned to the large triggers and you had a loss of momentum, I don't know what red pull means. You were in at 84? What kind of trade was it? I had momentum here. I didn't have it here. I can't take a momentum trade without momentum. All right. Guys, this is why we post pictures. So I don't sound like the doctor asking you where things hurts. Is it here? 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 So you got in earlier with momentum, and then when the triggers returned, you exited? See how I'm guessing a whole bunch here? TLC, you said all my triggers are still outside. That's freaking amazing. I'll get in. Oh no, they're back inside. Let me get the hell out. So with all that momentum, I didn't get greedy. I just took a chunk. And now that the momentum is gone, I'll sit on my hands and do nothing? How was that? We'll always get there with all the guesswork. I just need context clues. Is that about right? You maybe got in, I would say probably right there. When you saw it go down and go back up. And then when the small started to return, you said, you know what? That's money. I'll take that money. I don't know. All right, let's see if weak triggers and no areas inside. Let's see if it pays dividends or if they're just going to bounce from the middle of nowhere and go without us. Does anyone know for sure if it's going to be a mid-band or one-to-ones or fibs or a large chart mid-band? Does anyone know for sure that any of these areas will stop it? Only the trading gods know. Should we consult the trading gods? Will support hold? The outlook is good with all the triggers above, huh? Hold on. Will the mid-band hold? It is certain. Oh no. That feels like they don't even know. So Kenny, if there's no fibs inside of favorable large triggers, even with momentum on your side, isn't a high probability trade to be had? What are your rules, brother? Hey, Cav, take care. Man, I'm trying to keep it low. So, Kenny, here's the challenge. Okay, if your rules are Nexgen, were you here for the whole lesson on the correction point? That's okay, so let's go through it. So let's go through and we'll do exactly what we did with Josh. Because, man, these are great lessons. I really do believe that they are. That was the S&P, right? Check it out. So your first lesson, Kenny, your pick is unrelated to the pick. Your pick is unrelated to the question. So your question is, if there are no fibs inside of favorable large triggers, even with momentum on your side, there isn't a high probability trend trade to be had. Can I put trend in there? Cool. So what you're asking is that if the rules aren't met, I don't have a trade. Does that sound right? If I take the idea that no areas inside of favorable large triggers, and let's change the language to areas, not fibs, because areas can be fibs, it can be mid bands, and it can also be yellow one-to-ones. So if we say, Mark, even with all that momentum, if there's no areas inside of those triggers, then it can't be a high probability trend trade. That's the question. I'm making sure that I'm following you. Cool. So the answer is absolutely, Kitty. Without question and hesitation, if my rules aren't met for the high probability trend trade, I don't have a high probability trend trade, period. If my rules aren't met for an HVA trade, I don't have an HVA trade. If my rules aren't met for a 50-50 trade, I don't have a 50-50 trade. Once I deviate outside of my rules, then it's no longer that trade. Does that make sense? Cool. And I know that sounds like super basic, right? That sounds super like oversimplified. But you're absolutely right. So you don't have any areas inside of triggers, right? You have one before the large and you had some after the large, which gives us indecision. And isn't it nuts how it really can be that easy? Isn't it crazy how it would be okay for you to just say to yourself, man, that's not my best look for entry. I think I'll sit on my hands and do nothing. Or like I told everyone in the room, at least wait for like a reversal bar or some sort of confirmation. If you were hell-bent on taking a shot, give yourself a little confirmation when the rules aren't met. Does that make sense? And don't expect it to be a high probability trade anymore. Fibs, midbands, so it's not just that you need more than the midband. There's a very, 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 that was my Trump impersonation, specific recipe. Rule number 3 says that I will buy or sell a pullback at an area inside of triggers. Fair enough? That's the language. I will buy or sell a pullback at an area inside of triggers. So if you bought right there, technically that fits the rules. That's an area inside of a trigger. But the way I teach this class every day, Kenny, is that your best chance of success is when these triggers are one on top of the other, because what it does is it really limits the space where I expect the market to come back to. But that on its own isn't enough. It's not enough just to have triggers there. I don't know, Paul. Show me a picture. That's not enough just to have the triggers. The advantage comes from giving it something solid to bounce off of. Do we want to skip this lesson and go to the midband lesson? So when your triggers split, your advantage goes away. It creates indecision in the market. You don't know where it's going to correct. When they're tight, you have a better shot. Does that make sense? Let's focus on this lesson first. You comfortable with that? So when that midband is floating in the middle of nowhere, that kind of sucks. And it definitely pulls away. So when is the midband need to be cleared? And that was the next lesson that I was going to by blowing this one up, is a little understanding of patterns, Kenny, goes a long way here. And I'm going to show you exactly what I mean. And then this will segue into Paul's question. This is a bad bottom. Are you comfortable with the ideas of strong bottoms and bad bottoms, strong and weak? A good bottom, a strong bottom, is a no triggers through termination that reverses the market. So what Paul has shown us is an awesome, awesome strong bottom. What does that mean? That means that the likelihood of this 50-50 trade goes up. So understanding a strong bottom, these areas become more likely to break. This is a bad top. Because it's a bad top, do you see how the midband area ended up holding? Kind of cool, right? We can create that expectation. When it's a bad bottom, I'm a little leery of the midband. I'm going to make sure that my entry is perfect. When it's a bad top, look at the midband. When it's a bad top, midband, bad top, midband. Bad top, this one breaks, right? We clear everything, and then weakness sends us the other direction. So on this trade, and you're not the only one that took it, when we had that bad top in place, when it wasn't a termination condition that reversed the market, I just become leery of the mid-band. And I say to myself, man, this mid-band is the first place for a potential bounce because it's a bad top, because it's not the best of the best. It wasn't a termination that reversed the market. So when I get to the mid-band, I'm really saying I'll take a trade if my rules are met all day long. But because the 5-1 didn't give a solid entry, because the 5-1 had split triggers and no lines inside of triggers, and I understand that the mid-band is in fact the first spot for a potential bounce, I chose not to take this trade. I choose not to take this trade because not only am I at a potential bounce point, I really don't have the best looking entry ever. And I like things to kind of come together. I like them to be nice. So again, this bad top, and this one pushes a little further. We get those three divergences telling us that, man, the fight is still on. And even without a loss of momentum, guys, this is just interesting when you talk about the psychology of the market. They just created a pivot stop out without a divergence line that coincided with higher divergences, and the market's starting to push up again. Isn't that nuts? Look at it. You see it right there. And there's just a huge fight going on right now. So when they can't commit and get to an area, that mid-band is very often a bounce point. So you've got to be just a little aware of what's going on when you get there, Kenny. I think your read was a good one, and I think that you had all the large chart advantages for that one. And I think what happened is that indecision. And the same way here. Do you see how the areas end up beyond those triggers? And it so strips an advantage. And I know that I'm so matter of fact for new users, and I'm so blanket rules for new users. Once you find the easy ones, then the more difficult ones kind of present themselves, and you know how to manage it. And I love this one, TLC. You still had momentum, and you just didn't get greedy. You take quick profits, and the second it starts to shut down on you, you got out. Amen. Nice one, TLC. Great questions. No, divergence is not considered a strong bottom. Divergence is nothing more than a loss of momentum. So let's use Paul's chart as an example. This pivot with divergence, man, great questions. Thank you for this. Nothing more than a loss of momentum. That's all it is. Let's not make it any stronger than that, right? It's nothing more than a loss of momentum. All it is, hey, the sellers push down, and there's the sellers pushing price right to that price. And the momentum didn't follow. Because of that, right about here, the calculations are run, the negative number prints, and the cyan line prints off to the right. It's nothing more than a loss of momentum. It's not even price reaching it. It's a byproduct of a loss of momentum. Hey, take care, PC. Thanks for being here. And then, Kenny, when price comes back and reaches that divergence low and the triggers remain above, it's a termination condition. When it exceeds it a little bit and then trades back above, this is a very definitive pivot stop out. And because none of the triggers broke, once it reverses the market all the way over here, now it's a strong bottom. So it's kind of an order of operations. First, you have to have a termination condition. And then that termination condition reverses the market. Nothing about the PSO is a good top or bottom. This is just a pivot stop out. Cool. That's it, Muser. It's just a pivot stop out. It's a termination condition. Are you okay with that? Let's start there. PSO is just a termination condition. That's all it is. That's all it ever will be. When a no triggers through termination condition, why do I say no triggers through? Because here the market reversed, but it got above all the key areas. Here, none of the triggers broke through. When a no triggers through termination condition reverses the market, large triggers pinch and go the other direction. Pinch and roll. Now it's a strong bottom. So that's the recipe 100%. Is when let's pull the market up. Let's look at it. When this no triggers through termination condition, does everybody give me a Y? Muser, Kenny, this is a termination condition, right? Price reaches support. None of the triggers break. That's a termination condition. When it reverses the market, it grows into a strong top or bottom. And a strong top or bottom increases the likelihood of success of the trades that come directly after it. This is not a strong bottom. It's just a loss of momentum. This is a no triggers through termination condition. It's just a termination condition. But when it reverses the market, it's a strong top. I love this lesson. It's a good one. This pivot stop out is a no triggers through termination condition. When it reverses the market, it becomes a strong top. Does that make sense, everybody? So one has to happen before the other. First, let's see if we can find a good example again. I get a no triggers through termination condition. And guys, when it reversed the market, this became a strong bottom. But when it hit the mid-band and the large triggers didn't follow, that strong bottom's reign of terror was over because it's directly into a termination condition and we're not trading into termination conditions. And then when this mid-band behaving as a termination condition pushed it back down, that became a strong top. Once again, it was only a strong top till weak triggers at a fib that couldn't break it became a termination condition. There's your reversal. There's your strong bottom again. And then we start getting that clear path and you guys make money to the upside. So it's kind of an order of operations. First, it's a good bottom, or first it's a termination condition. You make sure that the triggers haven't broken through, and when it reverses the market, you're going to call it a strong top or bottom. And a strong top or bottom is the precursor to the highest probability trend trade you can take. So I have a 50-50 trade. Smalls are above, large are below. Perfect, Muser. Whoops. And then I'm just going to do this again, guys. My correction point extends. I'm looking for these triggers. And I'm looking for these triggers. And the only areas that I have, damn it all to heck, are not inside of either. Do you guys see that? So where's it going to go from? Ron, have a good one, man. I like it. Enjoy your Monday off. Is it going to go from the mid-band, should we hope? Is it going to go from the 1-to-1s? Is it going to correct down to those synthetics like it just did? Do you guys see how that indecision? If you got in at the mid-band, you just got shellacked. So let's just for grins. Let's wait for a reversal bar. And let's say, you know what, with split triggers, but odds favorable, 50-50, I'll make it give me a reversal bar to take this trade. So I'm going to put buy stop market 2, and I'm going to put it right on the reversal bar marker. I'm going to force it to give me confirmation. And guys, this is not a high probability trade. But you guys see how I did that? I'm demanding with this wonky honkin' look on my small chart, go in the direction of the trade. Go in the direction of that momentum. Make me believe that you want this market to go up. Is everybody cool with this, what we're talking about right now? I don't know, TLC. I can't see them. But my guess would be you have the wrong template. Very much so. So right-click, TLC, and go to Templates, Load, and put that 13.2 Renko bar chart. You probably have the NASDAQ one on there. There we go. We insisted on the reversal bar, which means that my risk is already established. $100 is at $36.25. $200 is at $38.25. I do have momentum. I'm not coming from a good bottom because we drew that white line in there. This does not fit the KISS plan. But my risk is established. I do have momentum. I waited for the correction point. This one doesn't fit my rules at all, guys, and it might win. It's a 50-50 from a bad bottom with split triggers, Josh. And it's almost difficult to rattle off all the disadvantages in one breath. And it might go. I don't know. We took it just for grins, right? We gave ourselves the best chance of success on this low-end medium probability trade. You'll notice that I'm on simulator. There's a reason. But here's one of the cool things about this, guys, is I do have areas and they're in front of the correction point, which means I can't be surprised if it goes to the correction point. I waited for a reversal bar, which means that I have established risk. I do have the best momentum ever on the large chart. So if you took this trade, you're taking a calculated risk. Again, it doesn't fit my plan. And look how price has been dancing. And they haven't been able to reach an area in almost 2 hours. And I'm not going to lie, I'm really rooting for a loser here. I'm hoping that it just rails through and hits my stop. Because what happens is that when this one wins, if this one wins, then this is the market teaching you to break your rules, guys. This is not a trade that has a statistical advantage. This is not a trade that's the best of the best. And look what's happening since we got in. My large triggers have rolled against me, which means now my trigger lines aren't even facing the same direction. My small triggers keep pushing down. And they're fighting right at these yellow 1-to-1s, right at that decision-making point, and you can see it. Does that make sense, everybody? Just when the moving averages come together, Kenny, that's all it is. So these triggers are moving averages for this chart, right? And we synthetically put them on this chart. These triggers are moving averages for the small chart. And just sometimes they come together. And when they come together, that's when it's magical, brother. That's when great things happen. That's when we have the highest chance of success. And the cool thing is I don't have any freaking idea why it happens. I know it has something to do with averages and all these things that I don't understand. But I don't have to understand how to build a watch to be able to tell time. All I need to be able to do is understand where my advantages lie and where they become a little sketchy. And then make decisions on whether or not I'm willing to take that trade. Does that make sense? The only thing good about this is the momentum. But I can tell you guys right now, this one might win. Right? How come? Because they keep trying to push up and the buyers keep trying to push down. Do you see how it could go either way? And is it a coincidence that appears to be the line in the sand? And half of my triggers are above it and half of my triggers are below it. Do you guys see it? So let me do this again. I love this. This is one of my favorite things. I think everybody should build one of these for their desktop. Hold on. I think everybody should create one of these and put it on your desk. The best of the best trade is three things, right? So guys, what don't we have? I don't have an entry area because it's not clearly defined with favorable large triggers. I also don't have a clear path. Am I putting my kids' college tuition on a scenario where my chart read says I only have 33% of my advantages? I'm telling you guys, build one of these for your desktop. And then, as expected, we just took an ass kicking because we traded hope. We relied on one advantage. Does that make sense? Guys, I did this on purpose, and I think I told you guys 10 bars ago that I hope it whips us. But I want you guys to see this, because is there anyone in this room? Is there anyone in this room that wasn't super hopeful that momentum would be what it takes to carry it through? Was there anyone that said, man, I would take that trade with that momentum. I'll take that trade with that momentum. You guys want to know where the momentum trade was? If you were going to take it, TLC, you'll love this. If you were really going to do it, where's my... When it cleared the problem with all that momentum and then exiting with a loss of momentum, that was about the only chunk. That's where Ron would have gotten paid. That's where Roku would have gotten paid. That's where Zorro would have gotten paid. Who else? That's where Erla probably would have made money. That's where Ron would have made money. That's where I might have taken a small chunk. But my expectations are real. I still believe this market has a better chance of going up than down. But why don't I just wait till it's perfect, right? Paul, it's not a high probability scenario. You'd have to take it based on momentum alone. And it's a different one. It's not a trade that I teach. It's not a trade that I teach. It never gave you a traditional momentum look. But guys, this is kind of one of the great things about having Simulator. It's okay to take the wrong trades and make mistakes. But what I really want you guys to get out of this is, did you notice how I talked through everything? And everything that I talked about revolved around advantages. I made a very informed decision to break my rules. I was very adamant to you guys that I don't believe this trade's going to win. But I did it on Simulator because I can't lose money on Simulator. That's where lessons happen. But these are the things, guys, if you don't make this mistake a few times, then you keep making it. If you don't present it in the room, I don't know that it's a challenge of yours. And this is why participation is such a big deal. It still may go up. I don't know. So Kenny, first, it's not coming from a good bottom. Second is it doesn't have a clear path. Third is that the triggers were split and there were absolutely no areas inside of them. There is an overwhelming amount of problems on that trade. And then Kenny, I don't know if you have it. You say that your rules are my rules. So for this classroom, my rules are the KISS trading plan. And check this out. If we go to the 50-50, is it from a good top or bottom? And the answer is no. We did have momentum, but we didn't really have an entry area. And then when Divergent said to exit the trade, then we still had to jump ship right here. Even if we took a shot at it, this was an exit condition. So even on the KISS plan, you shouldn't have been in this trade. So good stuff. Guys, I think that's our week.